Consumers are telling you that things are okay in the labor market.
The hot, tight labor market is still going to be an issue for the inflation outlook and for the Fed outlook.
It's not easy for the Fed, and markets, by occasionally loosening financial conditions, make it even more challenging for the Fed.
Financial conditions had an extraordinary run of tightening all the way through October of last year. That is what's impacting the economy now.
The economy is slowing, and we are seeing those earnings cuts. They're just not happening as fast as we would like to see them.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It's the hangover after a monster payrolls report, live from New York City this morning. Good morning for our audience worldwide on TV and radio, alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. This is Bloomberg Surveillance. Equity futures down 0.9%, TK in the bond market. Your two-year yield started Friday morning at 4.09%. It went through 4.40 a little bit earlier.
I thought a boring Monday. It is not a boring Monday, and my focus, John, is the bond market, where you've got massive inversion, 2's10 spread with that two-year yield moving out to negative 80 basis points moments ago. And I looked at the widest statement on spread. 3-month to 30-year is buttressed right down to 30-year inversion.
So we've gone from soft landing to hard landing to soft landing, and now we're talking about, wait for this, no landing. Torsten Slok over at Apollo put this out in the last couple of days. It is beginning to look more like a no landing scenario. Under the no landing scenario, the economy does not slow down. Upside risk to inflation return. And Lisa, maybe the volatile price action of 22 comes with it.
Well, that's the really focus that I have, is that if you do get a resurgent inflation and you do get a really resilient economy like what we seem to be getting, then what's to stop the Fed from going further? And that's what's getting priced into the market. That's what you're seeing on the front end. And perhaps that's what's driving some of the volatility in stocks.
So Chairman Powell last week talked about the disinflationary process starting. Does Friday's jobs report challenge that, contradict it, or support it?
Challenges that, because what you're seeing right now is incredible strength, and any way you cut it, people talk about seasonality, but honestly, people are saying the strength there, and also in services, climbing the most going back to 2020. Again, the momentum underpinning this economy, very strong.
I like what Ferroli and Silver said over at J.P. Morgan, writing Friday evening after that truly shock Friday that we had. It's a time will tell economy. Everybody is data dependent, and they take their GDP number for Q4. They nudge it up to 3.1%. That's a big number.
Well, I have to say on that data dependence, Tom, it wasn't just the payrolls report. The non-manufacturing ISM, big bounce, a major bounce, in fact, Lisa. And I think if you were looking at the economic data, you had a tug of war between sub-50 PMIs and maybe the labour market data. And we were trying to work out, how does that reconcile? Do you see the labour market break down towards where the PMIs are, or do the PMIs start to bounce back? I think on Friday, you got a hint, at least an early clue on where this might be going.
We know we've got a manufacturing recession. We have the opposite. We have a resurgent services sector because people want to go out and do things. And that really is what really was driven home on Friday. So any way you cut it, Jay Powell doesn't have to walk this back. It's being walked back by the data.
We've got a ton to talk about today, not just markets, but also a surveillance balloon. The balloon, Tom, getting fired down on Saturday. Did you see that?
Yeah.
Live shot.
I think it needs to be said. I was talking to my driver this morning. The Bentley's in there. It was cold this weekend.
It's freezing. I'm pleased to agree on that.
Yeah, well, the Bentley wouldn't start. I was really upset about that. Anyways, I'm talking to my driver, and he thought it's a balloon, like, a party balloon. And I said, there's 3 buses of metal that the balloon is
with a
carrying.
satellite.
He's like, why didn't they shoot it down? I said, well, they didn't shoot it down because, no, they think it's like around the world in 80 days. No.
We'll speak to our balloon expert in a bit, Tom. Bloomberg's Anne-Marie is down in D.C. She's going to join us in about 10 minutes' time. Equity futures look like this morning. Good morning to you. We're down 0.9% on the S&P 500. Yields bouncing back in a major way. 361 on a 10-year, up 8 basis points. Though, Tom, we keep talking about it. Your 2-year up 10 basis points. Just short right now of 440.
You want the thermometer to get through the week. It is the 2-year yield. The benchmark is a 10-year in from the 30-year long ago and far away. And I do agree the 2-year is sort of the easy way to watch the ebbs and flows of this as you try to have a confidence to stay in this bull market.
Lisa, that dollar strength continues. Euro dollar 107.65.
This is going to be about the data. We've been talking about that consistently. So does Fed Chair Jay Powell tomorrow have to walk back what he did last week with respect to perhaps a dovish readout, at least in markets? Perhaps not, because really the data is doing it for him. Tuesday, we also get President Biden giving the State of the Union address. This is not necessarily the same kind of week as last week. It is the hangover. It is the digestion week, but we do get a slew of earnings as well. well, including Activision and Blizzard and Pinterest today, Chipotle and Royal Caribbean, as well as BP tomorrow, Disney, Uber, Total Wednesday, PayPal, Pepsi, and L'Oreal on Thursday. To me, how much do we see ongoing shrugging off of highly disappointing results? These have not been good on a whole. If you take a look going back, in some ways, it's the least positive in terms of upside surprises going back to 2008. About half of the S&P has reported earnings. The S&P is up about 7.7% year to date. The NASDAQ has actually just saw its best start to the year going back to 2001. How much can we keep that going? And then it's also kind of light on the data side, but it feels like initial jobless claims is going to take on more weight on Thursday just because of what we saw on Friday. And the University of Michigan Sentiment Survey, when do we start to see inflation expectations over the next year increase again, John, because this is something that is very correlated to gasoline prices. Gasoline prices are starting to edge upward. Does this sort of challenge this sort of linear disinflationary narrative that seems to have taken hold of markets?
Lisa, thank you. When you Mitch calls you, Tom, what will you say about inflation expectations? How will you respond?
I think it has value to look out 5 to 10 years over the major sweat of any central bank, which is, are we unanchored? And do we have credibility? I'll give it that value. I'm way more interested in February 14th, Valentine's Day, U.S. inflation, February 23rd, Japanese inflation.
There we go. Spurs Milan, remember that, Tom?
It was great. I turned on the TV. I'm like, they played AC Milan.
You watched Spurs City?
I did. I did. I was amazed they pulled it out. I thought Jack Grealish
You've got 30 seconds to deliver your match review. You ready? Go.
My match review was the big guy for Man City's invisible.
Haaland.
They got a problem there.
People agree with you too.
There. You know, well, I don't know what I'm talking about.
There's a man who might score 40 goals this season, Tom, and he's a problem, apparently. We worked out why.
I don't know. I mean, I turned it on. I thought they were playing AC Milan. I looked at
they lost too last night.
Can we take a moment here, folks, for
a moment of silence for
Guy
Milan.
Johnson emailed me Sunday, and he says, would you talk to John about Six Nations rugby in Italy?
Italy almost beat France. I know.
Pretty cool.
We don't win rugby games. We came very close.
Tommaso Allen, his father is Scottish, his mother's
Did
Italian.
you actually watch this game?
Yeah.
Or have you been speaking to the floor manager and getting clues? There's no way you watched that game.
It's like Lucy and Peanuts when they kick the ball over the thingy, but the field goal. But anyways, nice job control. Tommaso Allen sort of like blew me away for Italy.
You notice they don't wear pads and helmets. Have you noticed that?
Yeah,
because they're harder.
It's really like, do they like in soccer? They get hit in the head. They stop the game for 15 minutes.
These guys
had never played.
Just keep going. All right, Tom, that was nice.
That was all right. Thank you, Guy Johnson, for mentioning.
We still lost. Laurie Calvasina joins us now, head of US equity strategy at RBC Capital Markets. Laurie, let's just start with the jobs report on Friday. It follows through into Monday. Equities lower. What did that change for you, if anything at all?
So, look, I think it's one data point. I think there was a view that emerged over the weekend in Friday trading that the Fed may have to stay higher for longer. We may not get the pause. We may not get the cuts. I'm still in the camp that thinks we are closer to the end of this hiking cycle and we're going to get the pause. And for me, it really underscores the idea that this economy is very resilient. I think there could have been some labor hoarding. I think that there are things that could explain that hot number, but I think we just see this time and time again, just evidence that the labor market is tight and that we are seeing, if you look at some other reports, we're seeing some indications that wage growth is slowing. I think that's probably enough to help inflation come down. So I'm not overreacting to Friday's report. For me, the broader thesis is still intact for now.
Laurie, what I find fascinating, I thought of you this weekend, Bloomberg reporting that Danaher is looking at a service company in the medical field. It's a mid-cap, smaller cap kind of thing. Not a zombie roll-up, but are we just going to see a roll-up in your small, mid-cap space because money finally costs something?
I think it's a potential catalyst for markets going forward in the small mid-cap space in particular. So one of the things we know about small cap companies is the quality is higher than it used to be. What we also know is that the price we're going to pay for, either skirting the recession or a short, shallow recession or a growth scare or whatever we end up calling this is probably going to be that economic growth is subpar for a little bit in percentage terms. And I think that incents companies who have a lot of cash still sitting on their balance sheets, who have very good structures in terms of their debt profiles, I think this is going to incent them to go out and buy some growth. And when you're looking at historically cheap valuations in small relative to large, it's something that simply makes sense. So I think it's something that we have to watch going forward. And I think it argues against a deeply bearish narrative in markets.
At the same time, if you talk about Torsten Slok's narrative about no landing, is that positive for equity valuations if that means higher rates for longer and companies having to justify their capital structures in a much higher rate regime?
I think it depends on exactly what you mean by higher rates. Now, if we're going back to something that we saw in the 70s, of course, that's going to slaughter PE multiples. We actually have a model where we bake in inflation, Fed funds, and also the 10-year yield. And we published an update on that this morning. We do have a couple cuts baked in for the Fed at year end, and it gets us to a 22 times multiple. We also have, the 10-year Treasury at around 3.4% and inflation moderating to around 3%. But let's say I just go in, Lisa, and flex those interest rate assumptions and kind of take the Fed number up and just leave it there. So don't bake any cuts and keep that higher for longer. I'm still looking at a 20 plus PE multiple on a trailing basis on this year's earnings. So it hurts a little bit, but it doesn't hurt as much as people think if you go in and do the math.
Laurie, I just want to finish on the rest of the world. China has gone from uninvestable to unavoidable, and then seemingly in the last 48 hours has swung back to something in between. Laurie, how much interest is there from your clients to invest abroad this year?
So it's been huge, John, and we've talked about this in the past, but I think investors came into 2023 just wanting to do something new. And one of the new things that people wanted to do was play the China reopening thesis. And I think raising the geopolitical angst and talking about worsening relations between China and the U.S., I think it complicates the ability to play that trade. So as we sit here and think about things that could push markets down in the short term or cause, things to just lose a little bit momentum, to me, frankly, that's, a more legitimate downside catalyst than say, oh, earnings need to come down a little bit more. I think the market understands the latter. I think the China issue it's challenging something that had gotten people very excited coming into this year.
Laurie, wonderful. As always, it's good to catch up and kick off the trading week with you. Laurie Cavasina there of RBC Capital Markets. The response from China over the weekend, Tom, from the Foreign Ministry, expressing, quote, strong dissatisfaction and protest, accusing the US of, quote, overreacting and, quote, seriously violating international practice. What do you make of that?
Greg Vallier published a few moments ago. We'll talk to Anne-Marie Horton about that, but it's a dramatically moving story this Monday morning.
And a pressure building on the president to maybe do something about export controls again. All over.
I wonder what it means about China.
I agree with you. Coming up in the next hour, not just on that, but also on this market, Michael Kushmer of Morgan Stanley Investment Management. He'll be joining us at about 7 a.m. Eastern Time.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Some of the most powerful earthquakes in decades hit the Middle East today, killing more than 1,000 people in Turkey and Syria. The first quake measured 7.7 and ripped across the border between the two countries. The second quake also hit the southeastern part of Turkey and measured 7.5. The quakes forced a halt in crude oil flows to a crucial Turkish terminal. Divers have been sent to recover what the U.S. believes is spy equipment from that Chinese balloon shot down off South Carolina. Bloomberg's learned the government expects to find equipment capable of taking detailed photographs along with other sensors. Now, lawmakers are demanding to be known if any of the technology came from the U.S. or its allies. In the U.K. this week, healthcare workers will walk out in record numbers. That will cripple the National Health Service and put more pressure on Prime Minister Rishi Sunak to resolve pay disputes. Nurses and ambulance workers are striking today. Nurses will take action again on Tuesday. Renault and Nissan have agreed on a landmark deal to reshape their alliance. Renault will cut its holding in Nissan from 43% to 15%. Meanwhile, Nissan will invest in Renault's electric vehicle business. The agreement's aimed at easing long-standing tension between the two automakers. And Dell has become the latest tech company to announce massive job cuts. It will eliminate a little more than 6,600 jobs. That's about 5% of its global workforce. Dell faces plummeting demand for personal computers. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
On Wednesday, when I was briefed on the balloon, I ordered the Pentagon to shoot it down on Wednesday as soon as possible. They decided, without doing damage to anyone on the ground, they decided that the best time to do that was if they got over water outside within 12-mile limit. They successfully took it down.
The President of the United States, what a weekend following that thing, the balloon being shot down, Tom. The response from China, equally interesting. The Vice Foreign Minister saying the following: China will resolutely safeguard the legitimate rights and interests of the company concerned. Lisa, you're going to have to translate this. And reserves the right to make further responses if necessary. Can you make sense of that quote?
So there was a lot of analysis over the weekend about Xi Jinping both trying to appeal to the nationalist bent in China right now and trying to toe a line of not caving to the U.S., but also not escalating some of the tensions. This is just basically a non-statement that gives you no sense of what's going on.
It's a weather balloon, Tom, we're told by the Chinese government.
Maybe
the U.S. government is saying it's a surveillance balloon that is controlled by the Chinese and traversed across the United States.
I think we know pretty well it's 3 city buses of metal underneath the balloon, and on there is stuff, and maybe it's a substance for the next Bond movie. We'll have to see. No doubt cast in the next Bond movie is Emery Horton, our Bloomberg Washington correspondent. Emery, I want to talk about one of the political things, which is they're going to bring this thing up, and they're certainly, let's believe, capable of doing that in relatively shallow water, and they're going to look to see if Cisco or Motorola, I don't mean to pick on those companies, but they're going to look for U.S. parts on there. How does that play in the white marble of Capitol Hill?
Well, if there's any U.S. technology that was used in this Chinese spy balloon, I mean, these companies probably are going to be that now under a serious microscope. Already we know that companies are under a microscope in the sense that the Biden administration over the course of the past 2 years, following on the previous administration, when the Trump administration was looking at ways that they could hit back on China in terms of getting their hands on sensitive U.S. technology. We had those export controls that were introduced in October. The Biden administration, on top of that, this is for the sensitive technology, the Biden administration, on top of that, was able to get the Netherlands and Japan on board with that. And now they're going to be pushed to do even more. But we just don't know yet what was on the balloon. So we should wait to pass any judgment on any sort of companies or technology.
So, Anne-Marie, Secretary Blinken was going, then he wasn't going. Is he still going to go?
At some point, this is a debate right now happening in Washington. Does he go even sooner to make sure that he now delivers a much harsher, aggressive message to China? This trip, there was not going to be any real deliverables. This was supposed to be the warming of the frosty ties that we saw back in the summer after Speaker Pelosi's trip to Taiwan. And it came on the heels of Xi Jinping and Biden sitting down at the G20 in Bali in November, and then most recently, Secretary Yellen and Liu He in Switzerland. But now, if Blinken was to return, and some are pushing that he goes very quickly for this meeting, which, remember, there hasn't been a Secretary of State that's been to Beijing since October 2018 with that very frosty visit with the former Secretary of State Mike Pompeo. Many are saying he needs to go and deliver a very different message to Beijing.
What about domestically? What's the message there? We were just hearing from Lori Calvasina and talking about the potential risk to this China reopening glory that seems to be taking over certain stocks. Is that going to get some pushback, some cold water from an administration that's going to try to crack down a little bit in terms of diminishing that economic relationship between China and the U.S.?
Potentially, but you look at the acrimony in words between Beijing and Washington, but you look at the trade data in 2022 is on the brink of cracking records. I mean, when you look at actually the business that's being done between the United States and China, you would not realize that there is this very frosty relationship happening and boiling at the top. Domestically, the big challenge the Biden administration has is the pushback they've gotten from the Republican Party. I imagine the president is going to be addressing the spy balloon in his State of the Union tomorrow, but Republicans are saying that it should have been shot down the moment it entered U.S. airspace, and they shouldn't have had an extra 4 days to make this flight path over towards, at the end, South Carolina, and then where it was shot down just off of Myrtle Beach.
What is your agenda this week, Emery Horton, besides listening to the Beyonce catalog? I mean, what is like the to-do this week?
Congrats to Beyonce. Epic.
Yeah. What's like the schedule?
Tomorrow is the State of the Union, so really everything in Washington will coalesce around what the president plans to say. It's an interesting moment for him because he's obviously going to claim victory, whether it's the economy off that stellar jobs report on Friday. Likely now there'll be some rewriting with the Chinese spy balloon. But also it's coming ahead of a time when we are expecting the president to announce his campaign for 2024. So the rest of the week, the president, as well as all the members of his cabinet, are going all over the country. Raimondo is going to New York. The president is going to a number of other states, and they are going to push their legislative victories and agenda of what they'd hope to accomplish in the next 2 years.
Do you think they've quickly edited that section on the labour market in America after Friday, Anne-Marie?
I imagine they did. I would be shocked if the president doesn't talk about the jobs number within the first 5 minutes of his speech tomorrow.
Hey, mate, thank you. Anne-Marie down in D.C., full coverage of that event taking place tomorrow evening right here on Bloomberg. Let's think about the timeline, Tom, Lisa, and the history of all of this. The president said that he was briefed about the balloon on Wednesday. We're being informed.
Really looked into this.
We're being informed that it's not the first time this has happened, and it happened also under the previous president. So Blinken was still going to China only until it became public knowledge that there was a surveillance balloon hanging over the United States of America. The reason I bring this up, I think it's really important to think about the language used from the Chinese, from the United States, from the Chinese government, and from Washington, D.C. Is this just for public consumption, theatre? Does it actually change the trajectory of policy when they already knew these kind of things were going on and they were still going to Beijing? And the only reason they didn't go to Beijing is because we all found out about it in the last couple of days.
Well, theater on both sides, right? I mean, basically, for both the U.S. and China. Really, this is the main question over the weekend. How much is sort of the theater of it going to dictate the contours of a relationship that potentially is fraught because Xi Jinping is trying to send a certain message to his people, and you've got President Biden trying to send a message to his people, and both sides are splintering. They want further relations, at least on a zeitgeist level. However, at a business level, they're getting closer and closer. So this is sort of the conundrum for a lot of people.
Hey, it's police, message in a bottle. I mean, as you say, they're messaging like crazy this weekend, and I think the whole Monday morning here is messaging. I love these phrases, John. They're killing me. On Renault, Nissan, it's an alliance reset.
Do you want to talk us through that alliance reset?
No, I don't want to talk to you. It's too complicated. It's such a soap opera. It's way more complicated, folks, than the straight-up reset to 15%. And the other phrase, this is from Deutsche Bank. Ready?
Go on.
Tactical layoffs.
Tactical layoffs.
Tactical layoffs.
I'm sure they feel super tactical for the people on the other side of them. Corporate language just drives people nuts.
Corporate language is out of control.
Okay, agreed, because these are people's lives. On the flip side, what you're seeing now is the layoffs that were not executed during the pandemic era are coming back in full force. And deciphering what's sort of a return to normal versus some serious cutback that is indicative of a changed economic cycle, very difficult to know.
You saw the numbers from Dow, Tom. 5% of the global workforce.
6,000 people.
Just kind of 5% here, there, and everywhere, right? Company after company.
It's
in that particular industry group, anyway.
Yeah, it's a PC thing, and I noticed Apple was a little light on PCs, iPad on a unit basis, saved the day. But it's just the ebb and flow out of the pandemic boom. Pandemic, let's buy PCs. Everyone's working from home. That's over.
Well, there's a little bit more, though, to this particular trend, because Dell is going back to the workforce that it had back in 2017. So this is going back way pre-pandemic to another level. What are we resetting? And you've talked a lot about this, John, in terms of what kind of excesses are we unwinding? Is it pandemic or is it pre-pandemic as well?
One number matters after Friday. 517,000. So many people doubting that number still, TK. Just looking at it and just thinking, yeah.
I'm still reading it, and guess what?
Where did that come from?
Number of hours worked, number of bodies working. That seems to be what the adults are looking at.
It was strong, though. It was strong.
Equity futures right now down 0.9% on the S&P. Coming up, Jill Moak of AXA in Investment Managers. A rough end to last week, a tough start to this week. Equity futures negative on the S&P. We are down by 0.9%. On the Nasdaq 100, we're down by 1.2%. 2%. Mislav Matejka over at JP Morgan saying position is quickly normalising. The question is whether there will be a fundamental confirmation for the next leg of the rally. They say, we think that it might end up lacking, Tom. They go on to say, we advise to use the current strength in order to reduce exposure. They're not bullish, this market.
That was channeling Mike Wilson, right?
They're on the same page, yeah.
There's a lot of that same pageedness going on.
Morgan Stanley and JP Morgan. In the bond market, we look like this, 2s, 10s and 30s. Bear in mind where we started the year, where we got down to on Friday and where we are right now on a 2-year. We started the year in and around 440. We dropped to as low as 4.03%. On Friday morning, we were sitting at 4.09. And we have jumped aggressively higher at the front end of the curve, back to 439.30, and went through 440 a little bit earlier this morning, off the back, Tom, of a really strong payrolls report, which has just totally upended expectations of what this Fed might do through the rest of this year. And as Lisa pointed out 30 minutes ago, it's over to you, Chairman Powell, tomorrow.
Further curve inversion, I agree. Chairman Powell will be of interest, but just further curve inversion. I saw negative 80 basis points on the vanilla spread, and I'm broadening that out. I'm looking at the very short-term 3-month, think of it as a T-bill versus the 30-year bond as well. Can we get framed here on the equity markets? Let's do the drawdown right now. Drawdown is bow tie talk from the peak. S&P 500. John, this is important for you. Negative 14%. The Dow Jones Industrial Average has a lesser drawdown, negative 7% within correction. And NASDAQ's harmed here. Maybe, John, is a partition of profit-making versus a non-profit.
You've got the year-to-date gains as well, Tom.
I don't have them in front of me.
The NASDAQ 100's up about 15%. Brammer went through them at the top of the hour.
I missed that.
Massive gains. A big move in euro-dollar as well. Let's get to that. We were talking about 110 on euro-dollar. Now we're talking about 107. Euro-dollar 107.59, negative 0.33%. It wasn't just the Fed last week. Chairman Powell saying the disinflationary process has started. It was also the ECB and President Lagarde suggesting that maybe things are becoming more balanced on the inflation front. Gilles Moak of AXA Investment Managers saying the following: the dovish nuggets in the Fed and the ECB's communication last week were sparser than what the market reaction would suggest. Tommy goes on to say the US payroll rightly put a dampener on the market enthusiasm.
Well, there it is. I mean, it's just as simple as that. And looking at 3 central banks, and very importantly, Mr. Moak, a real student of continental Europe, says Lagarde is the last hawk standing. Gilles, how hawkish are all these banks? I mean, after the summation of last week, has hawk disappeared?
No, I think hawks are still there. It's just that they are probably a bit less worried than they were a few months ago, because they can probably see that, or at least they thought they could see in the US case, that what they were doing is working, in the sense that gradually you could see the economy slowing down. You could see the monetary tightening working its way through the economy. So once you are in restrictive territory, even if you're a hawk, it makes you more comfortable on the pace of tightening. And this is, I think, exactly what Christine Lagarde told us last week, which is, we are in restrictive territory. We'll continue to hike. That message was, I think, a bit lost to the market last week. We'll continue to hike, but they can see some positive elements in inflationary pressure, which makes it possible that they will revert to a normal 25 bips hiking type rather than the jumbo hikes we've had so far. But the direction of travel for me is still very clear. We're not done. The terminal rate has not been hit.
Gilles, to me, the sequence of events here began with your French, and the answer is the French shocked and reported a better than good economy. In the coming, say, 2 quarters, do we underestimate European country-to-country GDP?
Actually, I would remain prudent on the coming 2 quarters, because, okay, Q4 2022 came up with a slightly positive surprise. We didn't have the catastrophe that we were fearing, because, gas supply did not completely dry out, so Germany didn't have to go into top-down rationing. But, France plus 0.1% quarter-on-quarter in Q4, Germany minus 0.2%, Spain plus 0.2%. I mean, we're just at the flotation line. And if you get into the first 2 quarters of 2023, yes, of course, we could expect some traction from the Chinese reopening. But, the monetary tightening is working its way through the economy, as I said earlier. And there was an interesting point in what the ECB said last week. They noticed that the credit impulse, if we can use the word again, the credit impulse has turned sharply negative in Europe. You can see, new flows of credit to the corporate and to the household sector drying up in Europe. So we may get some good news on the external side of our economy, but domestic demand might begin to be really impaired by the fact that we are in restrictive territory as far as monetary policy is concerned. And sometimes I think the market forgets about this. It's not going to be painless to bring your monetary stance from super accommodative to restrictive. There will be a price to pay.
And a lot of people have been talking about this. It's hard to imagine that we could go from negative to positive by a couple percentage points and that nothing would happen. Let's talk about some of the external factors, particularly as we talk about rising U.S.-China tensions. What's the potential bleed through if the U.S. turns to Europe and says, you too need to get a little bit harsher with respect to China at a time when the China reopening has been a massive tailwind for the European economy?
In terms of immediate impact on Chinese, on the European economy, I don't think it is that it matters that much because unless pressure from the US becomes absolutely massive, there will continue to be a rebound in European exports to China, just mechanically because of the way demand is moving there. I think it's more a medium to long-term issue. It's more important when it comes to supply lines, to investment in particular. And it's true that you can see the mood is changing in Europe around China. I think until a year, 2 years ago, there was a sense that the US was maybe a bit obsessed over China, and that Europe would try to find a sort of balanced way between the two. And I think in the last 1 or 2 years, it has started to creep up the idea that, hey, you may want not to be overly reliant on China for your supply lines, for your developing markets in the future. So it's not as central as what it has obviously become in the US, but you can see actually the mood moving towards the U.S. interpretation of what China is doing.
You can see the mood on the political side. Economically, though, how much of the gains that we've seen on the surprise to the upside has really stemmed from the reopening of China, from Germany in particular's ties to that nation and the need for investment, purchases, and supply lines?
For now, I think it's really marginal. I think we'll see it more into the first quarters of 2023. Q4 for me was really a story of a much-awaited catastrophe which did not materialize. I think we talked a few months ago, and we were really worried about the possibility that we would get into a sort of sudden stop in energy supply, especially in Germany, because we had a hard time finding the right alternatives to Russian gas. Thanks to the drop in German consumption, thanks to the fact that US LNG has arrived en masse and faster than we expected to European shores, we haven't had this sudden stop in energy supply, and this has allowed the German economy not to fall into a significant recession. But it's really the main driver as of now. China, that will come later.
Gilles, it's away from your remit at AXA, but today we have the picking up of the pieces of what I'm going to editorialize has been a less than successful joint venture of Renault and Nissan. Tell us about French manufacturing might. They're always compared to VW. VW, I think it's up 7 or 8% per year the last 20 years. Renault can't get out of its way, up 1 or 2% as well. But help me with the confidence that French manufacturing can move forward.
Well, manufacturing in France, anyway, plays a smaller macro role than in Germany. The services sector is much more dominant in France than it is in Germany. But the speed of deindustrialization has abated, actually, the last few years in France. And you still have a number of flagship companies which hold their own in that race. When you look at it, what's interesting is that you see a lot of cross-border alliance coming, not just the older one between Renault and Nissan, but just have a look, for instance, at what Stellantis has done, which is basically a joint venture between Peugeot, which is an old French car maker, Fiat in Italy, and Chrysler in the US. Through those international alliances, you can see that actually the manufacturing sector continues to do okay. But let's be clear: the French growth model for the last 20-30 years has been based on services. I don't think it's going to change anytime soon.
Gilles, just quickly to build on some of this and introduce a different topic: state subsidies. Gilles, how do you think the French and Germans are going to respond to what's taking place in the United States to push a green agenda?
I think the issue there is that obviously that comes down to our reaction to the IRA, and I think as long as we are focused on state aid, I think we kind of lose the big picture. What we need in Europe is more cross-border joint financial investment, the way we did actually during the pandemic with the new Next Generation Pact, which put on the table a lot of mutualized European funding for structural projects across Europe. I thought that we would have roughly the same thing in a reaction to the war in Ukraine, and now in a reaction to the IRA in the US. But for now, we haven't seen anything tangible on that front. And I think this is the missing link. Of course, if we continue to loosen state aid rules in Europe, this will allow more industrial policy from the likes of Germany, France, and the others. Yep. But the response should lie in a joint effort. And for the time being, this joint effort has not showed up.
Let's see if we get one anytime soon. Gilles, thank you for that. Gilles Merck there of AXA Investment Managers. Never mind the conflict between China and the United States, the tension between Europe and the United States, a big story in the last couple of months. Big story for Europe this morning. The focus very much on Turkey. We've had 2 earthquakes, Tom. The first was a 7.7 magnitude earthquake striking just before dawn. We're informed that so far it's killed nearly 1,000 people in Turkey and almost 250 in Syria. Then there was a second earthquake, Tom, of 7.5 that hit later on.
In 33 aftershocks, one of them moments ago, a smaller earthquake of 4.9. It is a set of aftershocks as people in the near freezing weather sit outside because there's nowhere else to sit.
Turkey's president says we've been shaken by the strongest disaster in a century. We'll bring you updates on that about every 30 minutes or so.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The search for survivors, it does continue after more earthquakes hit the Middle East, leaving more than 1,300 people now in Turkey and Syria dead. 45 nations have offered to help in rescue efforts. The first was a 7.7 magnitude quake, and it struck along the border of the 2 countries and was the most powerful to hit Turkey in nearly a century. Now, it put a stop to crude oil flows to a key export terminal. The second hit the southeastern part of Turkey. American lawmakers demanding to know if that Chinese surveillance balloon, which was shot down off the coast of South Carolina, was carrying technology from the U.S. or its allies. Divers are trying to salvage what the government believes is spy equipment from the balloon. It's expected to be hauled up in the coming days. The head of the International Monetary Fund warns that American consumers would suffer if the U.S. defaults on its debt. Kristalina Georgieva told CBS that a default would cause a spike in borrowing costs that would squeeze average Americans. There's a standoff between President Biden and House Republicans over raising the debt ceiling. Carlyle Group has a new CEO. Bloomberg's learned the private equity giant has chosen former Goldman Sachs co-president Harvey Schwartz. The announcement could come as soon as this week. Carlyle has been grappling with management turnover the last few years. And billionaire Gautam Adani and his family have prepaid $1.1 billion in loans in an attempt to stem a stock sell-off that's now in its 3rd week. The rout has wiped out $117 billion of market value in Adani's companies. It was triggered by allegations of fraud from short seller Hindenburg Research. Adani has denied those claims. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I think the people that have been really worried about a recession in the first and second quarter of this year, I think after what we've seen this week with both Chairman Powell's announcements and the data in unemployment, I think that recession is off the table for Q1 and Q2 of this year.
He's not alone. That was Gary Cohn, the former White House economic advisor under President Trump, speaking on CBS over the weekend. Tom, seemingly the view now is that you push it out. You push it out, or maybe even you take it off the table. Torsten Slot raising that question. I'm not saying it's his base case, but the man over at Apollo at least raising that question, Tom, going into the weekend.
I don't in any way want to pick on good Mr. Cohn in all he's done. But I just wish all these people citing recession calls would at least cite The Economist that they're getting the belief from.
Well, let's cite the economic data.
Micro work.
Let's go with the economic data. I think the Bears had two big data points in their camp, one bigger than the other. So let's lead with the big one. They had a services PMI, the ISM, sub 50. Yeah. They had hours worked declining and not climbing. And then on Friday, all of a sudden, they had this aggressive bounce back in the non-manufacturing ISM, the biggest bounce back going back to the mid-2020, just to give you an idea about the snapback. And then hours work actually increased. Lisa, they did not decline. And that's some pushback against the bearish view. Not my view, not my conclusion, not my judgment, just the data speaking for itself.
The data seems to support an ongoing momentum in the economy, which raises a question, okay, does this mean the Fed has to do more, number one? And number two, how long is it sustainable, given some of the excesses that people still think need to be worked out and that we see, given the layoffs that we've seen perhaps in the margins in the tech space?
I think it's just massively confusing. And the people I've spoken to, Tom, are grappling with the post-pandemic realities of this labour market and still struggling to draw conclusions. If we had said unemployment would drop to the lowest since the 1960s, what is it, 3.4%? Yeah. And then I said, well, guess the wage growth after a number like that. Would you have said, Tom, that maybe it wouldn't pick up? And that's the difficulty people are having with the incoming information.
And the reading over the weekend is clearly everyone is now massively data dependent. Again, I go to February 14th and the inflation number. John, I would just suggest, and this is something NBER doesn't have to worry about, if you have 1% economic growth, 1.5%, which I think right now is optimistic given a lot of views, what part of America feels like they're in recession, even if it's not a fancy recession?
It'll be interesting to see how Chairman Powell responds to some of this tomorrow at the Economic Club in Washington.
And to remind me, this is with David Rubenstein,
This is
right?
with David Rubenstein,
You think Chairman Powell asked him about Harvey Schwartz? You know,
possibly, sure.
Possibly.
Maybe a little back and forth. That would be nice, wouldn't it?
That would be good.
We'll take that.
We'll look forward to that. David Rubenstein, of course, with all of his commitment to Bloomberg in conversation with the chairman of the Federal Reserve System. Right now, this is a joy, and Lisa's going to launch on to other broader U.S. political affairs. But with Julie Norman, who is co-director of the University College of London Center on U.S. Politics, I have to go to her younger academic years of traipsing around the Levant. You've not been, Julie, in the earthquake region directly above Damascus, directly above Lebanon, in that northeast corner of the Mediterranean, but you have been northeast of there as well. It's pretty remote, isn't it?
So it's not a super populated area, Tom, but it's not, I wouldn't describe it as remote either. I mean, these are still populated areas, and obviously we've seen that from the death toll that is just climbing as we speak, at least 1,300 people killed. So I would say it's Gaziantep, for example, the closest city to where the epicenter was, is one of the centers where many Syrian refugees were fleeing for a number of years during the core years of the Syrian crisis. So these are areas where many people who've already faced extreme hardship in life, forced displacement, have been gathering and are now facing this devastating crisis as well.
Aleppo directly south, and we've all seen the horror of the leveling of Aleppo is how I would put it. How does the tension, the terrorism that you follow of the war of Syria and various parties, how does that obstruct earthquake relief efforts?
Well, Tom, any time that you have conflict ongoing, when you have a unstable government and governing system, and a place like Aleppo where there has been holdout from rebels, resistance to the state taking back over for obvious reasons, it's very difficult to coordinate any kind of relief. It's one reason that we've seen the group called the White Helmets, which again got a lot of press during the Syrian conflict, have been some of the responders at this. They're really the first to the scene. But in terms of reconstruction, in terms of rebuilding after this, it's going to be tough in places like that are, beset with many other challenges, even when there aren't natural disasters.
We'll keep giving updates throughout the morning as we get more on this developing situation, a tragedy where hundreds of people are dying. Julie, there is a question in the morning in the sort of mood about what the relationship between U.S. and China really is on the heels of that balloon that got shot down, the surveillance balloon, maybe the weather balloon. That's what China is claiming. What did you make of the Chinese response to the U.S. shooting down the balloon?
Yeah, so Lisa, it's interesting. I mean, I don't think it was a shock to anyone following U.S.-China that there's espionage going back and forth on both ways. So the fact that there are these kinds of surveillance tools themselves was not the main story, as much as it was just the brazenness of having it so visible. And I think it's still unclear with how intentional that was to have it be that visible. Was it intentional across the Chinese government? Was it one part of the Chinese government, or was this just a complete mess up on somebody's part? I do think it was interesting that China's response initially did seem to be a sort of crisis damage control. It wasn't just sitting back with the popcorn and watching to see how the U.S. responded to this. It really did seem alarmed that this was happening and playing out as it was. Obviously, since then, we've seen some of the usual rhetoric of the U.S. is blowing this out of proportion. This was, unnecessary to shoot down the balloon, these kinds of things. But I think the initial reaction said it all, that something did not go right here. And it put China on the back foot and on the defensive, I think, more than the U.S.
We've been talking this morning, Julia, about what the mood among the populations of the U.S. and China have in terms of an effect on the response from both President Biden and Xi Jinping. In China, how much are people looking for Xi Jinping to take a hard stance against the U.S.?
Well, I think there's obviously that look, and there always has been. But at the same time, China is coming out of a really unsteady period, trying to come back after COVID, restabilize the economy. And part of that means coordinating in some kind of way with the U.S. So I think there were at least some in China who were seeing this, the Blinken visit that got canceled, this kind of open communication as, okay, let's at least stabilize things, get things back to some kind of normal. And instead, when you see a crisis like this, send things into kind of unpredictable directions, that's not something that those who are just wanting to get back to stability want to see. So obviously there's some support for that tough talk, but at the same time, a sense of we don't want things going off the rails more than necessary either.
Julie, the team here at Bloomberg did a great write-up over the weekend of the F-22. This was Damien Shepard and Tony Capaccio, the F-22 Raptor fighter. They indicated this was the first air-to-air kill by that jet. Julie, it made me wonder, what do you think the Chinese learned from how the US responded to this event?
Yeah, so obviously there was going to be watching of that, but I do think it's important that the U.S. is also learning from the technology that they will get from this as well. And that was part of the administration's calculation. We've known from before that China has been able to learn from our aircraft. That was one of the reverse technologies that was seen as a real win for China. And I think the U.S. is trying to see if they can do the same thing with unpacking some of these intelligence apparatuses that they do now have hands on. But you're right. Both sides are always, I think, watching the other to see what are they using, how are they using it, and what can we learn from it to adapt in our own systems.
Hey, Julie, great. As always, thanks for being with us. Just perfect timing. Julie Norman there of UCL. Tom, you'll love this one. One defense publication, The War Zone, said on its website that the incident may be the highest altitude air-to-air kill ever. If you want to call this an air-to-air kill, some people might push back against that.
The balloon was shooting back.
Yeah. That was an air-to-air kill. The F-22 flying at about 58,000 feet.
Yeah, let's remind
altitude.
ourselves we're at 34,000 feet when we're flying fancy, so it's a lot more altitude up there. My problem is I hear too many people pontificating who have zero knowledge at all.
Oh, clearly speculating
about any of this.
We've got no insight into it at all. It is the gift that keeps on giving, though. Okay, according to the latest reports, China fired its weather service head amid the balloon fallout. Did you see that headline?
Funny.
I mean, come on.
This is.
You mean in terms of just the fall person for this, basically saying, this is on you.
I'm so glad, John, you mentioned Tony Capaccio, folks. Follow him over the coming weeks and months on this. He is absolutely definitive within defense reporting for integrity, and to have Tony on our side on our team is
We'll stay
great.
on top of the story, Tom. I think we catch up with Anne-Marie again in about 20 minutes' time. We've got to continue staying on top of this market action as well. Your 2-year yield is higher. to about 440, which basically makes it almost unchanged on the year, and the Nasdaq's up about 15% year to date still. I can tell you futures are negative. We're down about 0.8% on the S&P and down a whole lot more on the Nasdaq. Coming up next, Michael Kushmer of Morgan Stanley Investment Management. Looking forward to that conversation as we count you down to Chairman Powell speaking tomorrow.
Consumers are telling you that things are okay in the labor market.
The hot, tight labor market is still going to be an issue for the inflation outlook and for the Fed outlook.
It's not easy for the Fed, and markets, by occasionally loosening financial conditions, make it even more challenging for the Fed.
Financial conditions had an extraordinary run of tightening all the way through October of last year. That is what's impacting the economy now.
The economy is slowing, and we are seeing those earnings cuts. They're just not happening as fast as we would like to see them.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Taking a bite out of the 2023 rally on Friday. It continues on Monday morning. Good morning to you all worldwide on TV and radio. This is Bloomberg Surveillance with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures down about 0.75% on the S&P. The headline this morning, without a doubt, the move in the bond market. The two-year yield, TK, early this morning, 440 again on the two-year yield after seemingly at one point last week threatening to break back into the threes. It's a real turnaround post-payroll.
Well, turnaround, it's not only round trip, but it's the speed of the round trip. Boy, did we get back to a 4.38% on the two-year yield quickly, and you see it with a renewed inversion. First thing I looked at today was not the 2s, 10s, the vanilla spread, difference in yield, the 2-year, the 10-year. I took it out to the T-bill 3-month to 30-year bond, and that's really down to 30-year historic inversion.
I can tell you the equity market bears piling it on. Mislav Matejka over at JP Morgan this morning. Mike Wilson at Morgan Stanley just pushing back against that rally, Lisa, we've seen so far year to date.
Yeah, although so far you said that we're taking a bite out of the rally that we saw earlier this year. Maybe more like a nibble, right? Like we've already gone a long way so far this year. The bears saying, if you take a look at earnings, they haven't been good. So people are talking about the resilience. You haven't seen them in terms of profits, at least versus very low expectations. At what point, though, are they going to be justified if basically people are seeing strength, real strength, that's going to help support these companies? That's the issue.
Does Chairman Powell have to recalibrate the message when he speaks tomorrow?
I think the jobs report did it for him. He's probably going to enjoy that there's more volatility because that creates a certain constraint on the market itself. So that's really the question. Are they basically relinquishing their control mechanism over markets and saying, you guys figure it out for yourselves?
I'll talk about it a few times this morning. We mentioned it in the last hour. Torsten's Lock of Apollo. Tom, we have gone from soft landing, hard landing, soft landing, and now no landing. We've got a guest alongside us, Michael Kushmer from Morgan Stanley, who's going to join this conversation in a moment. Tom, the prospect that maybe you don't get growth rolling over, perhaps you reintroduce upside inflation risks after a blowout payrolls report.
Furley and Silver, JP Morgan, take this present quarter, the fourth quarter out to a 3.1%. And I didn't see their readjustment here, but Ellen Zentner, Morgan Stanley, was here with us Friday with a really cautious view on first quarter economic growth. That's a sudden deceleration.
That team's looking for a pause on Fed funds in March. They're looking for a pause.
Yeah,
Standard Chartered, Steve Inglander. Steve's going to join us in 45 minutes, also looking for a pause, maybe in March.
Yeah. You know, I think it's open to debate, and my answer is, guess what? They're data dependent. I really need to get to Valentine's Day.
That's been your answer for a while.
Yeah.
We'll talk about why you need to get to Valentine's Day a little
really
bit later.
I don't think it's CPI.
Is it CPI? Or something else? Have you actually planned for that this year? Let's hope so.
Just whisper in my ear,
Arnaud.
Arnaud. Anything from Arnaud.
Equity futures right now negative by 0.7%, trying to bounce back. They were much lower, so we're off session lows but still down, both on the S&P and on the Nasdaq too. Yields are a little bit higher by 7 basis points. Your 10-year 359.51. The 2-year earlier on through 340 TK, quite a move. And just to round it out, euro dollar 107.69. So a big turnaround. We were talking about what? 110 on euro dollar. We're back down to 107. We were talking about maybe breaking down through 4 on a 2-year. Now we're back at 440.
60,000 feet, which is 30,000 feet below the balloon or whatever. John, let's go to 34,000 feet and fly naturally.
Sure.
Guess what? It's real simple. Unemployment rate. Back to the age of Aquarius.
You're going to keep saying
the age of Aquarius. 1969.
Okay.
Michael Kush was looking at me like, I remember
a little bit before Bramo and My Time.
Yeah.
So, I mean, you ever heard of that song?
Yes, of course I have.
Oh, you have?
Of course I have.
There you go.
I grew up with
You lived
that
it too.
music. I didn't, in a sort of, meta form. Oh, let's talk about this week, because last week you came out and you said, this is going to be such a big week. Don't we say that every week? Okay, this week isn't going to be that big of a week. So I think that it's fair to say, let's call what it is. Last week was a massive week. This is the digestion week. Fed Chair Jay Powell perhaps helping that tomorrow with his speech at the Economic Club of Washington with our David Rubenstein, the formerly or currently of Carlisle. Also, President Biden is giving that State of the Union address. Curious to see whether he announces his run. This week, earnings continue. About half of S&P companies have reported earnings. This week, we get a view on the consumer. And this is actually what I'm more closely watching. Chipotle, Royal Caribbean, we have Uber and Lyft. What do we see in terms of the spending going forward? And then going through the data that we have this week, it isn't a massive data dump. But Thursday, we get initial jobless claims. And I feel like that takes on new importance based on what we saw on Friday. And of course, we get the University of Michigan sentiment survey, which I know you put incredible stock in, and the year ahead outlook for inflation. How much does it keep going down?
I asked Tom how he'd respond if they called, and he took that question so seriously, as if they call him every month.
Yeah,
they've never called me.
And they've never called Tom either.
Who are the people that get called?
I've always wondered.
Do they call cell phones?
Do they get a range? Do they get a range? Do you say you're looking for like 10 to 20, 5 to 20, 1 to 20? Pick a number. Okay, that's a story we'll pick up on later. Here's another one over in Europe. Deeply, deeply distressing and upsetting for many people. There were 2 earthquakes hitting Turkey today. The first was a 7.7 magnitude earthquake, striking just before dawn. The second was a magnitude that registered 7.5. We've heard from the Turkish leader. He said, quote, "We've been shaken by the strongest disaster in a century." Tom, you can weigh in on the aftershocks in just a moment, but the headline across the Bloomberg moments ago, the death toll in Turkey surpassing 1,000.
Oh, yeah. Oh, yeah. And as Julie Norman said from UCL, this is a populated area. The image of this is remote, is just inaccurate. There were terrible earthquakes in Crete. There was an earthquake in the 18th century in Lisbon where basically Portugal was flat. Lisbon was flattened. But in the modern era, back 200 years, Crete had 2 horrific earthquakes. Maybe, Cyprus, I think. I'm off on that. But in Turkey, I believe it's 1939 to get to the equivalency, which to Mr. Erdogan, I'm going to say is gently 100 years.
We'll try and get you another update in about 10 minutes' time. Then after that, every 30 minutes, we'll bring you updates on this story. I'm pleased to say that Michael Cushman's joining us alongside us in the studio at Morgan Stanley Investment Management. Michael, we can talk about this market, and let's talk about that number from Friday. We've gone from, soft landing, hard landing, soft landing, and now a conversation about the so-called no landing.
Right.
Where are you on that particular topic?
We've been pretty optimistic on the economy, simply because of the strength of the labor market. A lot of the reduction in consumer spending, I think, was voluntary. Prices are high, interest rates are high, so you don't buy stuff. You don't buy a house, but you could if prices were a little lower, if interest rates were lower. You're not constrained because unemployment's not going up. Jobs are plentiful for the economy as a whole. Obviously, there's a distributional effect across the whole economy, but overall, there was no reason to believe that any slowdown couldn't be addressed quite quickly if policy eased or if inflation came down, goods prices came down. So I think we're seeing this still schizophrenic relationship between goods price inflation falling rapidly because of post-pandemic, but the service sector, depending on labor costs and labor markets, is still quite vibrant.
You and I remember when money cost something. We've had 17 years, whatever, of a free lunch. We're now back to, as Taleb says, there's gravity in the system. I love your phrase, the shying away from bonds. Mm-hmm. We're afraid to clip the coupon. Okay, if that's true, which coupon needs clipping this morning?
First of all, I think that the market is forward-looking, but it got too forward-looking. It was looking through all sorts of things that were likely to happen this year. And I think Chairman Powell said it quite well. The market has a forecast, we've got a forecast, and we differ. And right now, the Fed's looking a little bit better in the short term than this market optimism. We're back at 2% inflation, everything's going to be okay. Fed cuts rates hundreds of basis points. So maybe just postpone your decision to buying a house a little later down the road. Mortgage rates come down. But suppose they don't come down a whole lot.
But which coupon right now does Morgan Stanley say I need to clip?
In terms of maturity?
Maturity, credit quality, Lisa Abramowicz's world?
I still think 10-year bonds over 3.75% on a treasury and buying investment grade bonds lower quality investment grade bonds, 5% plus yields looks okay because inflation will come down.
A lot of people are talking about the pause, including Morgan Stanley, Ellen Zentner, that the economic data will deteriorate pretty rapidly. What will make you change your mind and start to see some issues in the bond space, in the rate space, just simply because people aren't pricing it enough?
I think it comes down to inflation. Like the inflation, when things turned around in October, inflation started getting better, volatility peaked. I think the same day the equity market bottomed in October. And I think a lot of what's happened in the last couple of months is the precipitous drop in volatility, which has encouraged people to take risk, whatever it may be, in currency markets, in bond markets, in equity markets, and with a very strong view that inflation's now on the way down. The peak is in, Fed funds peak is in, everything, all peaks are in, volatility and risk are down. I think what's happened last week with the employment report and the rebound in the service sector, I didn't understand how the ISM services fell so sharply the previous month. I thought absolutely normal, it should rebound. I don't know why it was low. That reassess how fast the economy is going to get to the point where the Fed will cut rates. And I think that is now being postponed further in the future. And even the peak rate, we saw adjustments in that the end of last week.
What's the risk that the Fed's going to pause and then have to restart rate hikes later in the year?
Higher than it was. I thought a reasonable scenario, meaning 25, 30% chance, was the Fed did get to the point where they may have to cut rates a bit at the end of this year, but we'll find next year, actually, things never really get that weak. Then inflation bottoms at too high a level, and the Fed has to, okay, we're pausing the rate cuts, no more of those for now, and maybe the rates go back up again in 2024. It's not incredible to believe that might happen.
Just to finish up on this, I know on Friday that we priced in a higher terminal rate, more interest rate hikes, and all of the above. But just going through the economic data, I just wonder, unemployment dropping to 3.54% and wages not accelerating. Is there not something in that says maybe you don't have to go that far? What are your thoughts on that?
It's a good question. Right now, I think some of it has to reallocation of workers across the industry distribution. That higher income tech workers losing their jobs, but the service sector, sort of hourly workers and manufacturing jobs, accelerating still. I don't know if you've been to a restaurant lately in New York City. I was in London last week, same thing. I mean, you can't get a reservation in a restaurant.
It's tough.
And I think that's not anecdotal evidence, but it's indicative that there's a lot of money to be spent on things like that.
McDonald's 3rd Avenue, there's usually a seat available.
TK make it happen if you get stuck.
Service sector employment is still well below its peak.
There's been a massive focus on the demand story off the back of that payrolls report. We'll talk more and more about the supply side response, I imagine, in the months to come. Michael Kushner, this was great, of Morgan Stanley Investment Management. Equity futures right now on the S&P, negative by about 0.75%. Coming up in the next hour, Tom Titsouras, the head of fixed income research at Strategas, as equities take a dive and yields climb.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Some of the most powerful earthquakes in decades hit the Middle East today, killing more than 1,300 people in Turkey and Syria. The first quake measured 7.7 and ripped across the border between the two countries. The second also hit the southeastern part of Turkey and measured 7.5. The quakes forced a halt in crude oil flows to a crucial Turkish terminal. Divers have been sent to recover what the U.S. believes is spy equipment from that Chinese balloon shot down off South Carolina. Bloomberg's learned the government expects to find equipment capable of taking detailed photographs along with other sensors. Lawmakers are demanding to know if any of the technology came from the U.S. or its allies. Former Treasury Secretary Lawrence Summers said a soft landing for the U.S. economy is looking more likely. Still, Summers told CNN that the Fed may find it difficult to get back to its inflation target. He said inflation indicators remain unimaginably high. Carlyle Group has a new CEO. The private equity giant has chosen former Goldman Sachs co-president Harvey Schwartz. Schwartz will replace interim CEO Bill Conway, who will remain as co-chairman of the board. Carlyle has grappled with management turnover the last few years. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
It's not acceptable at all that China sent this object into our airspace. I don't know all the ins and outs of what this balloon was doing or what its capabilities were. I do know that when the president gave the order to have this handled, the military gauged the different risks and the different benefits of different approaches, made the decisions that they did, brought this thing down without incident.
That was U.S. Transportation Secretary Pete Buttigieg speaking on CNN over the weekend. China says it was a civilian research vessel. The U.S. says it was being used for surveillance. And just to prove that China's right, they fired their weather service head over the weekend. I mean, TK, just these headlines keep rolling in.
Yeah,
just getting ridiculous and more ridiculous.
You know, I got to admit it. It's so odd to go to fiction, and that would be Elliot Ackerman and James Stavridis' wonderful, my book of the summer a couple years ago, 2034, which is about unexpected things happening. This is not like the drama of Stavridis' made-for-movie, military, South China Sea and all that. But yet this is completely unexpected, and that scares adults in the military.
Sure. And for those of you just tuning in, China already expressing, quote, strong dissatisfaction and protest. And Tom, I just wonder how much of this, the language, the rhetoric from China, from the United States, from Beijing and Washington, D.C., is just for public consumption, theater, and how much of it will actually lead to a change in policy?
I don't know. They're going to haul the hunk of metal. 3 city buses is one article I saw out of the water. I'm sure they're able to do that. And they'll do an autopsy on it, and then there'll be even strong disagreement or displeasure, whatever, with China. What we know is the Republicans will sit in their hands. Tomorrow night, Anne Marie Horton joins us about the displeasure of Republicans and the State of the Union. She's our Bloomberg State of the Union correspondent this morning. Still, when that guy walks in the room and says what he says, Anne Marie, it is America. It is a moment for America. How will this president be greeted by this Senate, this Congress?
Well, he'll be greeted with mixed results given we have a divided Congress. But the president is really going to tout a huge number when he hits that podium tomorrow evening. And it has to be the jobs report on Friday, lowest unemployment rate since 1969. This is something he wants to hammer home. Also, you all were just talking about the Chinese surveillance balloon. I imagine the president will make the case, since he's been pressured a lot by Republicans. There's been a lot of pushback on the way that he decided to deal with the surveillance balloon. He will make his case on why he went with the timeline he went with and the decisions he made. Rewrites are pretty common. Remember last year, the president gave his State of the Union 6 days after Putin invaded Ukraine. Right. So there was a lot of reworking and late nights in the West Wing, and I imagine that is going on. I mean, a lot of it went on this weekend at Camp David, and I bet a lot of it will go on today.
Will he speak to the polarity of the country, or will he reach out to moderate Republicans?
I think the president will do what he has been doing, which is pointing out that there is a rebellious side, he would call it, of what he dubs the MAGAs of the party. And he'll likely look to those 20 that held up the speaker vote, those that are going to try to divide the country even more, in his words. And then I think he will look for a way to try to work with Republicans. This is a president who wants to tout the fact that he was able to work with congressional Republicans to get the CHIPS Act done, to get the bipartisanship done. I think the president needs to make a case to the American people, not just because he is going to be announcing imminently a 2024 bid in the next couple of weeks, but also this morning, a post-ABC poll says that 62% of Americans think Biden has accomplished, quote, not very much, or, quote, little or nothing during his presidency. That's quite harsh.
He's not a popular leader. Even within his own party, there are questions about whether he should be the individual that makes a run for 24. You mentioned 2024. Anne-Marie, will we get some kind of subtle reference to 2024?
I think we certainly will. Also, the president will be giving this address on the heels of the DNC this weekend, giving the green light for South Carolina to be #1 in the primaries. Now, it's not said and done. There's a lot of infighting because New Hampshire has a state law that says they must go first, and they are not backing down. But if President Biden, which is the one that pitched this idea, is able to get this done, this pretty much means he is for sure the candidate for 2024. We heard Ron Klain recently made the reference yet again, not if, but when you run for president, he wants to be there on his side. Biden is definitely preparing to make that announcement. It's likely to come in March or April.
There's the domestic concerns for him, but also internationally. And I do want to finish. John was talking earlier about the battle of perceptions from both the U.S. and China. Where is President Biden going to sit on this? How much will that be a part of the State of the Union when it comes to addressing what kind of tact the U.S. will take, particularly with businesses and doing business in China?
I think what you've seen from the Biden administration is similar approach you saw from the Trump administration. Look, those Trump-era tariffs that they were debating for a while, if they should lift them to help the inflation cause, they are still intact. This administration is now going after sensitive technology that goes to China. This administration is going around the world, talking to countries and businesses to try to move individuals to look at friendshoring or nearshoring. They are trying to get business on board, and this is what they're going to likely discuss. I imagine the president will likely include in his State of the Union. And the balloon issue and this espionage issue will just be a mirror into a larger issue that many Republicans are talking about. Like Senator Mitt Romney took to Twitter almost immediately saying, yes, you all see this massive balloon in the sky, which literally you could see if you were in Montana or South Carolina. But what about the millions of what he calls spy devices in individuals' pockets? And when I say that, I'm talking about TikTok. So the president has to address this.
AMH, thank you. You read my mind. I pulled up the tweet as you were speaking. Thank you. Senator Mitt Romney, a big Chinese balloon in the sky and millions of Chinese TikTok balloons on our phones. Let's shut them all down. Lisa, we've been talking about this for a while, haven't we?
Given the fact that TikTok is a Chinese-based company and potentially could collect data on the U.S., also has a different version of TikTok that is available in the U.S. to the one that's allowed in China. The one in the U.S. has fewer controls over it than the one in the United States. Will they actually take action, though? Because how popular will this be with younger voters at a time when a lot of politicians are using different outlets to get their message
using
across.
TikTok to reach them at the same time?
I mean, literally, that's true. You know, doing TikTok dances. Vote for me.
You mentioned the difference. Isn't it more educational in the mainland for the young people that use TikTok in China?
I'm not an expert in this.
There are bigger guardrails.
There are bigger guardrails where you don't have the same kind of attention, like deficit disorder kind of scrolling through and just nonstop entertainment. There's certain filters that are more educational.
We're going to change that, Tom.
I looked at it for 1 hour a number of days ago for Bloomberg management to say, you know, should I be on TikTok? And I can tell you that what I observed there was not educational.
What was your 60-minute study? What was your conclusion? Should you be on there?
Searching words, searching names, going Bramo.
Seeing what came up when
Pharaoh, see what came up.
Came up. Me doing the Macarena?
Your kids are out there. I just don't know what to make of it. All I can say is I'm scared. I'm petrified of the time wasted on social. We were so lucky we didn't have this.
Here's a question for you. If TikTok was American, could it get access to Chinese markets?
Absolutely not.
Right. So why are we even having this conversation?
At this point,
brilliant, John.
Do you put the genie back in the bottle? Can you? And this, to me, is really a question, or does it really bleed into, censorship and freedom of speech? Has it become more controversial than it might otherwise be after so many people did become, I would say, for lack of a better word, addicted?
YouTube and Meta would love them to put the genie back in a bottle, don't you?
I would argue that's one of the reasons why Meta shares are doing as well. Some people are arguing that they could do really well if TikTok gets banned.
You guys get all the love notes. I get the hate mail, but I would suggest a lot of people have tried to put Bloomberg surveillance back in the bottle.
Back in the bottle?
Back in the bottle.
Do you think it should go back in the bottle?
I said, I mean, this bottle's got this shape and that bottle's got that shape.
One of those ships that's assembled in a bottle. I never knew how
to... like the Chivas bottle has a certain shape.
Toothpaste is out of the tube. You can't put it back in. All
so
of that stuff.
Are you drawing an analogy between toothpaste out of a tube and
This show is broken eggs. You just can't undo the omelette.
It's got a Monday feel.
It is what it is.
It's got a Monday feel.
Oh, happy Monday, Tom.
5 weeks of gains on the Nasdaq 100, up every single week this year, and then it has to confront some turbulence on Friday and into Monday.
Terrible
Equity
news.
futures are down by 0.9% on the Nasdaq, down 0.75% on the S&P. Mike Wilson of Morgan Stanley saying this morning it may take a bit longer for the market to price our materially below consensus view on earnings, and the fact that the Fed and Fed policy is restrictive in the context of an earnings recession. We remain convicted in our thesis. The bears this morning piling it on. We're negative down the Russell by about 0.8%. In the bond market, 2s, 10s and 30s look like this. Your 2-year through 440 a little bit earlier this morning. Started the year at about 442. Got as low as 4.03% intraday at one point this year and seemingly threatened to break into the 3s. And here we are again off the back of a blowout payrolls report. The Fed chair last Wednesday said the disinflationary process had started. Mohammed's been counting. Al-Arian in the FT this morning. He said Fed Chair Jay Powell referred to disinflation some 11 times.
Yes.
He pointed out the word did not come up at all in Lagarde's news conference or Andrew Bailey's press conference either. What do you make of that?
Brilliant. This is Al-Arian, why he's so good. He's absolutely right about the Fed focus on disinflation, and there was a dearth of it as we attempted to declare victory. Churchillian, Bailey, and Lagarde, I'm not sure what she was doing, just trying to get through it and calm people.
She said the inflation story was becoming more balanced, and Eurodollar's taken a dive ever since off the back of some of that data on Friday, at least. Payrolls engineering some real dollar strength. Eurodollar seemingly looking at 110, and then bank Bramo 107.72 on Eurodollar this morning.
The interesting thing is, perhaps Madame Lagarde did not mention disinflation, but the read-through to markets was the same as though she had, right? I mean, basically, people were reading the same message into both, regardless of the perhaps different emphasis. I will say this week we are focused on earnings. We have reached, or we're about to reach, the halfway mark with respect to S&P earnings. I just wanted to point out a couple of names ahead of the Uber and Lyft earnings that we get later this week. Tesla shares are up this morning after saying that they are going to raise the cost of their Model Y long-range vehicle by $1,500 to $54,990. This is for you, Tom. The reason why I think this is interesting is because there was a sort of race to the bottom that was the narrative last week, for some of these electric vehicle manufacturers. Perhaps that's shifting just a bit, or at least more nuanced. Uber shares ahead of their earnings on Wednesday rising. They said that they were going to sell a stake that they had in a Russian taxi and car sharing joint venture, and partly that might be why they're up 0.6%. But really, people are looking at consolidation of market share. We saw Lyft greatly underperform Uber last year. Those shares lower by 2.2%. And John, to me, I'm curious, do we see this in terms of the dualities when you've got two major players? Do you start to see a lot more concentration of business in one as the economy perhaps doesn't soften materially, but changes and normalizes in a new monetary regime?
I won't pick out single names, but we do have to study the viability of some of these businesses that cropped up in a world of zero interest rates. And I'll give credit to Joe Weisenthal, who said this repeatedly. The bubble of the last 10 years wasn't just built on the foundation of low interest rates. It was cheap and stable labour prices as well. And that story, Tom, has changed markedly over the last couple of years.
To me, the fundamental thing, and it'll be studied for 10, 20, 30 years, is the Amazon dynamic and what that did to regional economies where you pop through $12, $13, $15, $17. Somebody told me the other day that, the new $17 is $22 an hour.
They added 1 million employees in the pandemic. One company.
Yeah.
One company. I mean, that number is just amazing, Tom. It's amazing.
We'll have to see. We got terrific news flow today. At some point, we will talk about Renault and Nissan. I think there's a backstory there that's fascinating for Europe. But right now, Michael Shull joins us, Chief Executive Officer, Market Field Asset Management, with a very, very nuanced note there. How did your view change, the Market Field view, after 517,000 plus 54,000 revisions? How did the labor economy of the United States adjust your view?
I mean, I thought it was strong, and Friday's numbers told you it was strong. I do think it's one of those reports that looks like a bit of a statistical aberration. It's sort of strong across the board. It's a weird time of year, and you had all of the 2022 adjustments thrown into that. So, I think probably we're still creating about 200,000 jobs a month.
Yeah.
All of the labor metrics look okay. And in Friday's number, particularly in the household survey, you discovered a bunch of the missing jobs that Jay Powell had been talking about, which it's not shocking. I mean, the labor data is strong.
The Market Field view is a more long-term view. we're now back to where money costs something.
Yes.
How much? Speak to people that have never enjoyed what Michael or Aaronstein have enjoyed, or speak to how we're back to now where money costs something. How does my life change?
Well, I mean, the question is, are you operating in a kind of business that can generate enough cash flow that money at 5% is unimportant? I think for a lot of the economy, it's really still okay. I don't think the sort of what we would call the sort of old economy has really been devastated by interest rates. I think the problem is much more in people who have been very, very creative with financial engineering attached to a business. And there, which is a lot of the sort of PE, VC portion of the economy, there I think 5% is going to matter. I think we're going to be at or around 5% for a while. Frankly, we're going to be at or around 5% until things start to fall apart.
This talk, of course, of going abroad. Only a year or so ago, China was totally uninvestable. We start 2023, and I'm told repeatedly it's unavoidable. The events of Friday and over the weekend, does it change how we want to be invested in the China story?
Look, I think there's two big issues. One is that the Chinese have switched from, really a very bad COVID policy to a more manageable COVID policy. And monetarily, they've gone from tight to loose. So that's really, really positive. The thing that hasn't changed, and it's been true really since 2018, is the sort of geopolitical aggravation of investing in China. It's not a lot of fun. I mean, we found that out in Russia last year, where everything we had there, which wasn't much, was wiped over a weekend. I don't think China itself is that attractive for those reasons, but that whole region is now much, much more attractive. I think some of the markets surrounding China are investable. I think the Japanese, as a byproduct of yield curve control, have also sort of involuntary switched to a very loose, monetary policy. So I think Asia and the portions of the U.S. market that feed into that, are suddenly doing quite a lot better.
Does this extend to Europe?
Yeah,
to London even? The miners listed on the FTSE. Does it extend to them?
The FTSE made an all-time high on Friday.
A record. No one's talking about it.
No one talks about it.
I missed that completely.
Made an all-time high. And it's been struggling, struggling with this level for, since 1999-2000. So it does for that portion of the London market. I think it does for the German economy, which is still tied, into that. So I think for, a portion of global economically sensitive equities, the news has got materially better in the last 4 months.
How do you decipher the signal from the noise at a time of such noise, particularly short covering and some of the volatility that we saw last week?
Oh, I think it's really hard. My phone didn't stop ringing like Thursday and Friday last week from people trying to work out what on earth is really going on. Look, some of the technicians I respect think they've seen enough to call this a new bull market. I don't. I think that the change in monetary policy last year still matters. I think that we might be in this really weird situation that an index like the S&P equal weight might have finished its bear market last year, but the index we actually follow, which is the headline index, which is dominated by large cap tech, I think is still in a bear market.
I want to build on that and just give this color that Thursday's short covering was the largest since November 15th, according to Goldman's trading desk, to give you a sense of just how violent it really was in a historical perspective. Big tech, you don't think it can recover from here, even with all of the job cuts? Is that what you're saying?
Yeah, I don't think the NASDAQ 100 is going to make a new high in 2023. I'd be shocked if it did.
Why?
Because I think it was grotesquely overvalued when it did make its all-time high. And I think these sort of 10-year bull markets, when they end, take a long time to give you a new high. It doesn't happen in 10 months.
You studied commodity cycles. You mentioned some optimism, Pacific Rim ex-China.
Yeah.
This is how I'd put it. Is that enough to get oil above $100 Brent? Is that something that's more probable than many would think?
Yeah, I mean, I think it's got a much better chance of being 160, at $80 today.
I mean, I'm deciding, do I need 2 barrels in my living room like Lisa had?
No, I don't think it's crazy. But I think you have to realize that the weakness in crude oil prices since last summer was caused partly by what was going on in China, which we assume is getting better. But it was also caused by massive releases from the Strategic Petroleum Reserve, And I think one thing's for sure in 2023 is we're not going to see that happen again.
They can't repeat the act, that's for sure.
No, they can't.
Michael Shao of Market Field Asset Management, how can you repeat the act, Tom? They're looking to rebuild the thing.
No, I think this is really important. To have a conversation with Michael is important because it's a broader international view. To borrow from the balloon, it's a view from 60,000 feet, and it's synthesized down to where you have to have geo-financial bets.
Sure.
And to hear him say their Pacific Rim, I go back to what J.P. Morgan said in their 100-page Brent crude study of, a year ago? And you could say, well, they were wrong, or maybe they were just early, and all of a sudden, does our world fall apart with $110 Brent crude? I'm not sure.
Can you be both? Wrong and early. I mean, if you're too early, you're wrong.
That defines my career.
Tom, last year, the FTSE up 0.9%. Didn't
really?
have a down year.
Sort of a Brexit
Didn't
year?
Have a down year.
Is that in sterling or is that set in pounds?
You've got to take the mix. It's in sterling. You've got to take the mix and think about the fact that the FTSE is bulked up by staples, financials to some extent, and energy. And if you take the likes of energy,
it's less computery service sector.
Energy is about 12% of the index. Energy on the S&P is something like 4%. Think about the time that energy's had over the last couple of years, and it makes sense.
Oh, this is very important,
Which is why
folks.
some people have been bearish, and still to this day, I think Mislav Matejka at JP Morgan is one of them. You can be less than constructive on, say, the S&P, to Michael's point, because it's dominated by big cap tech, and still be overweight somewhere like, say, the UK, the FTSE, the large caps on the FTSE 100, because of that tilt. That mix, the composition is different.
On a Monday, to interpret that for you, Bramo and I want to let you know that it's a Ferro correction. The FTSE is not the Dow Jones Industrial Average. There's a makeup. It's very different.
Market cap weighted.
It is. But the FTSE 100 is not the American index. I don't think that's said enough.
Of course not.
Yeah.
Well, it just doesn't have Microsoft, Amazon, Meta,
the
Google,
stuff.
Apple. All that good stuff. Steve Englander's going to catch up with us.
Good.
Steve at Standard Chartered was looking for a pause from the Federal Reserve in March. How does the payrolls report change that? That conversation coming up. Futures down, trying to recover negative 0.6%.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The search continues for survivors after more earthquakes hit the Middle East, leaving now more than 1,500 people in Turkey and Syria dead. 45 nations have offered help in rescue efforts. The first, a 7.7 magnitude quake, struck along the border of the two countries and was the most powerful to hit Turkey in nearly a century. It put a stop to crude oil flows to a key export terminal. The second hit the southeastern part of Turkey. American lawmakers now demanding to know that if that Chinese balloon, which was shot down off the coast of South Carolina, was carrying technology from the U.S. or its allies. Divers are trying to salvage what the government believes is spy equipment from the balloon. It's expected to be hauled up in the coming days. The head of the International Monetary Fund warns that American consumers would suffer if the U.S. defaults on its debt. Kristalina Georgieva told CBS that a default would cause a spike in borrowing costs that would squeeze average Americans. There's a standoff between President Biden and House Republicans over raising the debt ceiling. Renault and Nissan have agreed on a landmark deal to reshape their alliance. Renault will cut its holding in Nissan from 43% to 15%. Meanwhile, Nissan will invest in Renault's electric vehicle business. The agreement's aimed at easing long-standing tensions between the two automakers. And Beyoncé has broken the record for the most Grammy Award wins ever. She picked up 4 more awards on Sunday, giving her 32 of them. Still, Beyoncé came up short once again in the top categories. Harry Styles, Lizzo, and Bonnie Raitt split the 3 biggest prizes. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Perhaps what we're seeing here is the inability of the Fed to really get to its goal, which is to rein in the inflation pressures from a market. Powell said it again on Wednesday. It's still a labor market that is too hot. What we're getting wrong and where the confusion is at is a tremendous distortion in the economy from COVID.
That last line is so important. That was Jeff Rosenberg, the portfolio manager over at BlackRock. Have we fully understood? I don't think we have. The post-pandemic realities of this labour market, tremendously difficult. And I think the word I would use after Friday is just confusing. Confusing for many people. Futures right now on the S&P and on the Nasdaq negative. We're down about 0.6% on the S&P, trying to recover here, TK. Yields are higher by 7 basis points, 359.32. Do you want the high of the year on euro dollar? I'll try and bring that up for you quickly. Euro dollar was staring down 110 at one point this year, Tom. The high of the year on a single currency was 110.33, and we did that on the 2nd of February. Right now, 107.82.
A little bit of a move, and John, we haven't mentioned it this morning, but the VIX backs up, and it doesn't back up really as much as I thought, John. I thought it had a 20 feeling, but at 19.43 right now in the VIX with the SPX down 0.6%. Really not all that much of a move, even while we did see stronger dollar, a little bit of a dollar reversion here.
There's a great line in Al Arian's piece in the Financial Times today, Tom. It's about whether Chairman Powell, who is scheduled to speak tomorrow, would, quote, correct the market's understanding of what they heard and saw. It's a great line in the FTTK. Will we get some kind of walk back, Lisa, tomorrow from the Fed chair?
Does he have to walk anything back if basically the market's doing it for him
Sure.
with the payrolls report? So why not let people kind of think their own thoughts and they'll do what they do?
And adjust to the incoming information, Tom. Data dependent.
We're data dependent. What's going to be interesting about this is the probability and the interpretation of it. Now a clinic. Stephen Englander's out of Yale University with a storied career. He holds court at Standard Chartered Bank, where foreign exchange is very important. He's global head of G10 FX research. Stephen, I went all Bayesian the other day, and we're not going to go there because I flunked Bayesian probability, I think, 3 times in a row. But you say suddenly we are conditional. I think this deserves explanation. Tell me what the conditionality of all of central banks is right now. How do we switch from unconditional to a conditional analysis of the Fed?
Yeah, I think the big shift that Fed Chair Powell made on Wednesday was in going from a view that the Fed had to raise rates and pretty much under all circumstances, and downplaying the the possibility that they wouldn't be pushing them up. Basically saying, look, we have a target for where real rates have to go and we got to get there. Wednesday, he sort of said, the market's too optimistic. We think we have to raise rates further, but we'll see whose forecast is right. The conditionality is the conditionality on the way things turned out. And I kind of agree with Lisa that he doesn't have to walk much back. He said, he'll probably say, well, it looks like our forecast was better than the market's forecast.
Within that, Steve, is then ex post, in that in any conditional or probability analysis, you try to get out front or you act later. Are we still as ex post as we believe we are?
Well, I think he feels that they have the luxury of being ex post at this stage because real interest rates based on forward-looking break-evens are about 2% or higher. So I think that, there's a consensus within the Fed that that's reasonably restrictive, maybe not perfectly restrictive, but also maybe too much. So I think that now he can let the data guide them on how much further they have to go.
Steve, let's talk about that dollar smile. Steve and Jen's great work in the FX market. 2 extremes. The dollar can strengthen when the US is great or things are just absolutely terrible. Steve, are we going to flip back to one from the other?
Well, look, it's funny because on a recent trip to Europe, most clients were more concerned that the economy was going to slow too quickly. And, that we might be on one end of the smile. Now it's sort of like an electron. The fear is that we're going to be on the other end without having stopped in between. I think this is one of the big uncertainties in the market right now. If it turns out that the labor market is tighter than expected, accompanied by more inflation pressures than expected, there's a good chance we'll be on the risk-off, dollar-positive end of the smile. For my read of the data, the inflation data looks still primed to come down. The earnings numbers weren't terrible the last 6 months. Earnings have either been 0.3 or 0.4, which is probably consistent with 3 to 3.5% inflation in the U.S., so not where they want to be, but well below where inflation is running now. So I think there's a possibility that if we don't see a pickup in inflation, even if the Fed feels that it has to hike more than what the market is projecting, that it could be consistent with a fair amount of at least risk neutral, if not risk positive. They're not tight. They wouldn't be tightening to sort of drag the economy down. They'd be tightening to sort of put a little tension on the reins to prevent it from overheating.
Stephen, we've been talking about positioning and what we saw last week with respect to the short squeeze on Thursday that was historic in its scope. How heavily are people positioned toward the euro at this point, given that all of our guests seem to say that they prefer Europe or they prefer international over the U.S., and could make that rally in the dollar that much perhaps more significant?
Well, I think they're less positioned now than they were at 8.29 on Friday. I think the numbers were so striking that I think that those who had profits were trying to protect them, and stop losses were getting run. I think the market's going to wait. Right now, it's trading on a risk-off basis. I think that the market's going to wait and see what the CPI tells them is happening with inflation, and then decide kind of whether it's a growth kind of surprise or an inflation surprise before kind of really kind of figuring out how much of the remaining positions have to be unwound.
Meanwhile, do you think it's kind of a heads we win, tails you lose kind of scenario for the dollar? Because either way, either a softening or a strengthening could potentially benefit a currency that a lot of people thought would have a weak year.
It's possible, but you have to consider that there's a lot of positives for other currencies. Both asset market valuations are low. By historical standards, both G10 EM currencies are weak. If you're looking at Europe, it's the first time, 6 or 7 years that are positive interest rates, so that, there's going to be some portfolio adjustment, even if it's not, sort of a massive sort of buy Europe view. I think conditions are kind of favorable on a number of bases, which may mean that we don't go as far as had been expected in dollar weakness. I mean, that's a risk, but it's it may not mean that trade is completely reversed.
Hey, Steve, it's great to catch up. Appreciate it. Some great work over the last couple of weeks. Steve Englander there of Standard Chartered. That note after Chairman Powell on Wednesday, going from unconditional hawkishness to conditional hawkishness. Well, I think we got the conditions for that hawkishness on Friday, that blowout jobs report. Equity futures were deeply negative this morning. I can tell you we're trying to buy some of that weakness. We are recovering just a little bit. Yeah. We're down by 0.6% on the S&P. And TK, that is happening even as the move in yields is not fading. At the front end, we're still higher by 10 to 11 basis points.
Maybe a quiet after the 4-day storm. Last week was exhausting, I found. And, it's a quiet after the storm, and we're going to wait here to go out to February 14th. There's some other data along the way as well. I think we've done a great job on earnings because we haven't focused just on the techs. Lisa's done a great job on the rest of the world out there. Timken, Canton, Ohio, 18,000 people. They make something as prosaic as ball bearings. They're as industrial as you get. Do you want to make 12.9% per year for 20 years? That's a pretty good return. It's not Apple. Maybe it's not, pick a stock, John.
Meta.
Meta.
Amazon.
And boring ball bearings, Canton, Ohio, 18,000 bodies, 12.9% per year for 2 decades. Tim Thien over at Citigroup says net pricing was a surprise. A standout was shock. John, they could raise prices and get away with it. I'm thunderstruck.
$6 billion name.
Yeah, nobody reports on this. The financial media,
because it's a $6 billion name. That's why. The fascination.
It's a Lori Calvasina name. I get it, but Apple, Alphabet,
totally.
Meta, Tesla. Let's do more Tesla. We should do more Timken.
The coverage has boiled down to basically something like 5 or 6 names.
Okay,
because
10.
of their dominance at the index level, and the conversation has shifted away from what maybe it used to be on Tom. I'm with you. Futures are down 0.6 on the S&P from New York. This is Bloomberg.
market expects inflation to come down quickly to the target.
Yes, there are signs inflation is decelerating, but this inflation fight is not over yet.
The Fed is still hyper-focused on inflation, but particularly that inflationary element coming from the labor market.
For inflation to get to 2%, you're going to need that pain in the labor market.
Given what we know about the trajectory going forward, there's risk that employment will remain strong.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. After the jobs report, a quiet Monday not. The bond market moves, and we'll recalibrate that with a wonderful guest to start the hour in a moment. Loved having Priya Misra on twice last week from TD Securities. And John, it's real simple. It's a Priya Misra Monday with curve inversion, negative 80 basis
She
points.
thinks the Fed's got more work to do. And after that payrolls report on Friday, a ton of people agree. 517,000, unemployment at 3.4%. TK, it wasn't just the labour market report. The non-manufacturing ISM survey had a massive bounce back into expansionary territory, the biggest bounce since the middle of 2020. I think for a lot of people after Friday, they're just throwing their hands up in the air and saying, I've got no idea where this economy is going.
Fair, and I would say the reading over the weekend, I guess I'm not surprised by this, but it was a reaffirmation of negative on the equity markets. Ben Laidler, always a bull, said, look, there's a serious fear of missing out here, and it's a fear of missing out on everything across the spectrum, maybe even including bonds. But the preponderance I read was pushing against Mr. Laidler.
So we had a couple of people, including Hyperconvexity out on Twitter, who I thought had a wonderful line in the last week or so. It's not about valuations and fundamentals. It's been about positioning and flows. And what Mislav Matejka of JP Morgan has said this morning is that positioning is quickly normalising. And the question is whether we will get a fundamental confirmation of the next leg in the rally. They think you won't. Yeah. And ultimately, they say use the strength to reduce exposure. That's the message that comes from JP Morgan, the investment bank, over the last week. In fact, the last number of weeks.
My answer is look at the tea leaves. And Lisa, the tea leaves here are different credit issues of the bond market. How did bonds move Friday? Not so much distress, but even corporates. How did they adjust to 554,000, whatever it was, with the revisions?
Ongoing credit tightening, spread tightening. Basically, what we're looking at did not give way. In fact, it just doubled down because strength in the economy reduces the chances of a company going under, which is the reason why, yes, the bears might have reaffirmed with respect to equity valuations, but they reaffirmed their bearish view perhaps to a lesser negative. And we heard that from David Kostin over at Goldman Sachs. Yeah, he does think that the index level could go down, but not down quite as far as he previously did.
It's sort of a jumble here of the weekend. We don't have a jumble tomorrow. We have clarity of the Democrats hate the Republicans. The Republicans hate the Democrats. Your thoughts, Lisa, and we get with State of the Union.
There's only really one thing people are going to be looking for, and that's the announcement of the 2024 race from President Biden. Other than that, I mean, how much?
He's not going to do that, right?
Well, he could hint at that, and this is going to potentially lay the groundwork. I'm also curious about potential departures to his cabinet right after the State of the Union, because that's really what a lot of people have been waiting for. At least that's the feeling.
I'll go to 80 basis points right now. Let me go to 3 digits, John. Negative 80.000.
What's that?
On the 210 spread right now.
Oh, there we go.
Printed moments ago.
Nice work.
What else do you see in the data?
Futures were lower, much lower, and now we're bouncing. We're negative just 0.6% on the S&P. You've got to think about where we've been. Lisa mentioned spreads. High yield spreads are 200 basis points tighter than the wides of last year. The Nasdaq's up 15% year to date. The dollar is 10% off its peak. All of that's taking place, and the chairman of the Federal Reserve is saying financial conditions haven't changed too much since the last meeting. The Fed chair is going to speak tomorrow, Tom. That's going to set the tone for this market. Lisa's made the point a couple of times this morning that this market has responded to the incoming information. It's adapting to that totally with her. But some people might be looking for validation, confirmation from the Fed chair himself.
Interesting voices this morning, and I'm going to go to Michael Schul. I thought was brilliant.
It was great.
About a more holistic global feel as well. Right now, we're going to take it and take another view, and I love this. Tom Satoris joins us right now, head of fixed income research at Strategas. They are a Baird company. And Tom, I just love your note where you say have the courage to look out. You're essentially already walking beyond 2023 and really thinking about what 24 looks like.
Yeah, absolutely. And just a little bit more proximate, looking at 2023, we're still looking at a recession happening sometime this year, but a shallow one where essentially the Fed is not successful in its mission in bringing inflation down to a 2 to 3% target. but rate cuts nonetheless eventually hit later this year, or more likely early next year. But once you start seeing the Fed cutting rates, let's say early next year, when inflation is bottoming not at a 2% or 1.5%, but a 3 to 3.5%, you're talking about yields off to the races again, second half of next year. So we're already looking out towards next year. And beyond this, what we're saying is a double-dip recession is most likely what we're going to see over the next few years, because there's going to have to be serious damage done to the labor market to get inflation down this cycle.
Wow.
And I just don't think the Fed
Double dip like 80, 81?
Exactly.
Down? I've never heard that. That's original.
That's like the post-crisis conversation, Tom.
Yeah.
10 years ago. Before we get to the second recession, can we talk about the first?
Sure, absolutely.
We just had a payrolls report that had unemployment at 3.4% and payrolls at 517,000. Recession? What recession?
So this looks a lot to me like, we'll say, third quarter and fourth quarter of 1999. We had 6% GDP third quarter, 7% GDP fourth quarter, and it was a blow-off top. You had businesses hoarding inventory ahead of Y2K. Some differences. The Fed was tightening. The market was saying the Fed's getting close to being done, but we're still growing strong. And then all of a sudden, 2000, you're down, and it's just down fast. Today, businesses are hoarding labor. That's not sustainable, especially when you see operating margins compressing and you see labor productivity negative. That's not a good thing. So that itself doesn't look sustainable. But another things that we're looking at is lower income cohorts, households, are spending well beyond their means. Credit card debt is growing. Credit card debt is at an all-time high. Credit card interest rates are at 40-year highs. That's not sustainable. Middle income, higher income cohorts, they're dipping into savings at an astounding rate as well. That's probably more sustainable because they've got a huge cushion. But you put it all together, we're seeing shallow recession because eventually the consumer wobbles over. And once the consumer wobbles, then businesses stop hoarding that labor like we saw in 2000 with inventories. And then you get that cascade effect. But it should be fairly shallow because we do think by the time this happens, we're talking later this year. And now the Fed's starting to pivot towards cuts for 2024.
Well, that's what I was going to say. What's the Fed's response to a shallow recession? Is it rate cuts if inflation hasn't really been killed off?
I think they're gonna hem and haw on this as long as they possibly can, but eventually they will pivot towards rate cuts, but not this year. Now that's interesting because the bond market, as of Friday morning before the jobs number, was pricing in cuts as soon as we'll say October or November of this year. So the market this morning is pushing those cuts further out, it looks like, but the Fed is still going to have to wobble itself towards cuts or pivot towards cuts at some point next year, I believe.
Is just a shallow recession and nothing deeper enough to justify credit valuations where they are, given the ongoing rally that people have really played into?
Yeah, I would say no, both in the investment grade and high yield space, no. I mean, we got IG spreads, investment grade corporate spreads, somewhere around a 115 to 120. Even in a shallow recession, historically, you're talking about 180 to 200. That's a very shallow recession. And by the way, you can make the same extrapolation to the equity markets, where you're looking at how much do earnings contract in a shallow recession. It's 15%, 20% perhaps. So nothing seems to line up with even with that shallow dip in earnings and output that we're expecting. So there has to be some risk asset pain.
Chairman Powell, Volume 2. Tomorrow. Can we finish there? Do you expect anything different from the Fed chair?
No, I think what he's trying to tell us is we don't know where we're going to terminate the funds rate. It could be 5, 5.25, 5.5, but we're confident we're going to hold it there for a while. And we don't know what a while is, but it's probably for the remainder of this year. Beyond that, he's data dependent. I hate that phrase. We all hate that phrase.
Tom loves it.
But we need to see numbers. We need to see the jobs numbers, and we need to see how quickly inflation's coming down. And all of it comes down to one important data point or concept that you're not hearing people talk a lot about today: labor force productivity. If labor force productivity somehow rises and participation rate rises, then it's a game changer. I don't see that happening, though.
Participation did on Friday. Is there anything about the data at the moment that makes you think, I don't really know what's happening here? I can't draw conclusions about the post-pandemic realities of this labour market.
Well, that's a head-scratcher, and what we can broadly say is it seems that 18 to 25-year-olds are still, to some extent, boycotting this market, this labour market. We don't know why they're doing that. We can suspect, we can give anecdotal reasons, but
Tom's going to give you one right now.
We all have, and we can have our cynical reasons why, but for whatever reason, they are boycotting this market. And when they do join the market, the labor market, they're not putting their best efforts forward. So labor force productivity is negative.
One of the great things of Strategas is the inbred optimism of the shop when Jason Trennett started it. Don't tell me Jason Trennett's 100% in cash. What's the equity belief at your shop?
No, so we're looking at, again, consistent with a shallow recession, a modest earnings contraction, and that means that, say, the S&P, let's put a ballpark here, let's do $200 per share for earnings for this year, and a 17.5 multiple. That gets you, we'll say, $3,500, and if the Fed, pauses and pivots sooner than expected, maybe you get back down to 3,600, but we're still bearish at these levels on equities. We just don't see the
fundamentals. I just love to hear bond guys talk equity.
I just enjoyed that assessment of Gen Z. They don't want to go to work, and when they get to work, they don't want to work.
They don't put their best foot forward. Did you like how gracefully you put that?
You think Tom's doing reviews with the analyst class of 2022?
Maybe. I'm guessing that it's going to be a really interesting time. I wonder, though, what's going on? Do you think it's just social media? Do you think it's just...
No idea. Don't know.
Where's work from home right now?
No, seriously. What, on their productivity? That I've got no clue. But if you go back to the labour market of Friday, to see unemployment at 3.4%, to see payrolls growth of 517,000, and then if you just left the wage number blank and said, guess what? I don't think you would have come up with what the wage number is right now.
The compositional aspect, though, is interesting because there are some more lower wage jobs that are getting created than the higher wage ones. But you're right. Why aren't we seeing that pressure? And if we don't, is it okay to see really robust job growth for a Federal Reserve that is looking for inflation, not necessarily for more people to lose their jobs?
Which is why I said this morning, when the Fed chair says the disinflationary process has started, does the payrolls report on Friday contradict that or support it? Be interested to see how the Fed chair himself talks about this if it comes up tomorrow.
I don't think we know. Nobody's given an answer.
I've got no clue.
It's a morass of unclarity. That's sort of what I feel like.
Hey, Tom, this was great. Thank you, buddy. Good to see you. Tom Titsouris there.
Tom, thank you.
Thank you. Coming up, Isaac Boltanski of BTIG, the President of the United States, an address to the country tomorrow.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Some of the most powerful earthquakes in decades hit the Middle East today, killing more than 1,500 people in Turkey and Syria. The first quake measured 7.7 and ripped across the border between the two countries. The second also hit the southeastern part of Turkey and measured 7.5. The quakes forced a halt in crude oil flows to a crucial Turkish terminal. Divers have been sent to recover what the U.S. believes is spy equipment from that Chinese balloon shot down off South Carolina. Bloomberg's learned the government expects to find equipment capable of taking detailed photographs along with other sensors. Lawmakers are demanding to know if any of the technology came from the U.S. or its allies. In France, more strikes and protests are planned by unions opposed to President Emmanuel Macron's pension reform proposal. The National Assembly starts debating the measures today. It includes increasing the minimum retirement age from 62 to 64. Carlyle Group has a new CEO. The private equity giant has chosen former Goldman Sachs co-president Harvey Schwartz. Schwartz takes over for co-founder Bill Conway, who became interim CEO last August when Kyu-Sung Lee resigned after a power struggle. And Dell has become the latest tech company to announce massive job cuts. It will eliminate a little more than 6,600 jobs. That's about 5% of its global workforce. Dell faces plummeting demand for personal computers. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I can assure you that if we fly a balloon over China, they're going to shoot it down, and probably a lot sooner than we did. This is not a coincidence that this thing traversed the United States over sensitive military sites, leading up to Blinken's, what was scheduled to be his visit to China. This is deliberate. They did this on purpose. The message they were trying to send is what they believe internally, and that is that the United States is a once great superpower that's hollowed out, that's in decline.
Republican Senator Marco Rubio of Florida speaking on ABC over the weekend. Live from New York City this morning, Good morning. Equities look like this on the S&P 500. We are negative by 0.6% on the S&P. Off-session lows, though, taking a bite out of those losses from earlier on this morning. The low of the session, we were down about 1% on the S&P. Yield still higher on the 10-year by 7 or 8 basis points to 360. The action on the 2-year fascinating, up 10 basis points, just short of 440 rather. Had a look at that earlier on today. 439. Now on a 2-year. That is a real change. At one point last week, we were having a conversation, Tom, about breaking down into the threes at the front end of the curve, and we are moving in the other direction.
And I think we need to say this because in the equity market, it's intuitive. And I think for bonds, it takes some work. At least it knows that. The bottom line is when you have this move, it's yield up, it's price down. There's a lot of people looking at the whipsaw. Maybe they're not even trading. They're just holding. And they're like, am I having any fun here? And I'm not sure.
They've had a lot of fun year to date. Let's be clear about that in fixed income.
Yeah.
Less fun after Friday, and that less fun, if you want to call it that, Lisa, continues this morning.
Who the person it's been more fun for is people who had deposits at banks that now can go into T-bills and make 4%, 4.2%. And you're seeing a lot more people do that. Deposits have been flooding out of banks.
Well, I think this is what David Costin over at Goldman's talking about. I'll share the quote from him this morning with our audience and you, Tom. The combination of limited upside in our base case, substantial downside risk if the economy dips into recession makes for a challenging distribution of outcomes for equity investors. And here's the line, especially relative to the alternatives. And Lisa brings up an alternative, Tom, which will give you 4%.
Which is yield and coupon. We talked about that earlier today. How quaint. Michael was with us from Morgan Stanley.
Mr. Kushma.
Yeah, Mr. Kushma, thank you. That's how Bill Gross started his job.
Clipping coupons.
Bill Gross was in the mailroom at the Pacific Investment Management Company with a pair of scissors in his hand. And you actually,
it's a physically,
which I've done,
yep.
You clipped the coupons. And that's back, Byzantine.
Well, this is why we used to talk about gilts, Tom, and gilts were that gilt-edged certificate.
Oh, were they? Is that what it is? A certificate is gilt?
That's gilt-edged. That's
very good.
That's where that came from.
We're learning every day. Isaac Boltanski's about ready to hang up on us. He joins us right now, Director of State of the Union Research at BTIG. Isaac, your research notes are great because they're wicked granular. Does your world matter given the political gridlock we're going to see on display tomorrow night?
Yeah, look, I think that tomorrow is a big show, and we're always interested as to what the president has to say because it does provide a little bit of insight into perhaps what the administrative state here in D.C. is going to do. That alphabet soup that runs the town from the EPA to the CFPB. But there isn't much that's going to happen on Capitol Hill. Really, I think tomorrow night is going to be more about what it means for the administrative state, how 2024 is setting up, and maybe, given the events of the past few days, how Congress is going to be tackling the China question.
In your granularity, where is the equivalent bipartisan to the bipartisan angst over China? Domestically, where's the bipartisan?
Yeah, look, I think there are two things that are unifying and animating here in D.C. The one is China hawkishness, as you mentioned, and the other is big tech bashing. And so when I think about big tech bashing, you've got the far left and the far right and everyone in between with their concerns regarding the growth and expansiveness of the big tech companies. The problem there, however, is what is our response? Because both ends of the ideological spectrum have a disdain for big tech for different reasons.
You put the two together, Isaac, and you get TikTok. And how much of a groundswell do we get of trying to ban TikTok in the U.S.?
I think this is real, Lisa. I think that at the beginning of this story, there were some divisions over how to address TikTok, but you're starting to see those dissipate. And really, I'm focused here on top Democrats in the Senate, like Senator Mark Warner, who runs the Intel Committee. And you're starting to see even his concerns, which were about the slippery slope of banning free speech, starting to change. And he's pushing a new bill. You've seen other comments from Senator Bennett that are noteworthy. Look, I think the risk here is real. And I think that there is a viable scenario where TikTok is banned. What I'm highlighting for clients is I think that their CEO coming up in March to Capitol Hill to testify is one of those rare moments when a congressional hearing matters. I think that that's ultimately going to have great bearing on how D.C., whether it's Congress or the CFIUS review that's ongoing decides to tackle the TikTok question.
On a broader level, is there really the political will in Washington, D.C. to diminish business opportunities of American companies that are looking to go over to China and doubling down on that for the sake of national security?
So this is why it's always difficult to say that the bilateral relationship is going to end between China and the U.S. We are too entwined, and each one of these issues represents its own set of complicated matters, but also as part of the broader whole, right? And so when we talk about TikTok and what can be done there, you have some domestic concerns about those who are making their own money on the app, or the fact that a quarter of those folks between 18 and 29 get their news primarily from the app. Those concerns are real. Now, more broadly, I think that you've seen this bipartisanship here in D.C. over China hawkishness lead to a real focus on the flows of data and the flows of technology. And that's where, at least, I think we're seeing enough uniform thinking to see action.
Isaac, I've got to ask you this quick question here. We've got to run, but you are Ohio Wesleyan. You understand the fabric of the Midwest like few that we talk to. The gloom that's in the media, is it an East Coast phenomenon? Are things better out there than we perceive?
Yeah, look, all politics, if we're talking on the political side, all politics are local. And I think that the divisiveness here is reflective of a broader divide in the country. I think that we'll see that when we watch a State of the Union tomorrow night, and then we see the various different responses, both from the Republican Party and within the Democratic Party. And so I think the division is real. That doesn't necessarily mean that it's nearly as bearish as we often are inclined to suggest.
Isaac Boltanski of BTIG. Isaac, thank you. TK, what do you make of this spectacle? I understand the heritage of it. Should it continue?
I'm a sucker for... Oh, the State of the Union?
Sure.
Absolutely. No, this is a huge deal. The justices are all there. There's somebody, I can't remember who it is, but a designated cabinet member, somebody has to sit at the Holiday Inn and have a beverage of their choice while they're doing it. You know, there's a drama. There's a drama to it. They're going to show the cameras. The Republicans are going to sit in their hands. And all who we shake.
Speaker Pelosi ripping up the speech.
Yeah.
Well,
I mean, you know, it's both sides have been doing this now for a while, Tom.
This is the turmoil of the last 4 or 5 years, and everybody's got a political angle here, but there's a pageantry to it that is the modern American political experiment. Was it changed? Yes.
There's a tension because it used to be the leader and bringing the country together and sending a united message of what the country wanted to do. And now it's an exercise in, or maybe never, maybe you would disagree, it was never that way. But that was sort of the thought was, what is the message from the person who is leading the nation? And now it's increasingly, you know, a place to highlight the divisions more than anything else.
I really take issue with this, John. I grew up feeling the visceral admiration and hatred for FDR that was there from grandparents and people like them. Cocktail hours usually started on Cape Cod like 4:30, 5 days a week. Little Tommy was in charge of bringing the peanuts and
Tommy
the nuts.
having a drink.
No, that didn't start till later.
That's what we all want.
But I remember the visceral hatred and affection for FDR, no different than what we see
in the next hour. Nothing but affection. James Anthony of Aberdeen, Matt Brill of Invesco, Jay Pulaski at TPW,
Wonderful.
Leslie Falconio
of
UBS, all coming up on Bloomberg TV.
Bloomberg Surveillance, we welcome you on a Monday, always after a jobs report. It's supposed to be slow. It's not. Really interesting movement in the bond market. We'll cover that in a moment. Yields higher. Equity markets give back, but there's a little bit of movement here right now. 19.51 on the VIX. Futures were grimmer earlier. They come in negative 27. Standard & Poor's Dow futures negative 170 at 3. But in the bond market, Lisa, let's color here, Lisa, right now. Negative 80 basis points is the inversion. The 2-year yield is 0.8 percentage points higher than the 10-year yield. What's a so what of that?
Well, another way to put this is that basically how much damage has to be done, or how much does the Fed have to raise rates to bring inflation back down to that 2% level or back within that range? And that spread sort of suggests that. The so what is, if you're making so much more money to put your money in cash than longer-term instruments. It tells you that people are willing to just park their cash under the mattress over long-term slowing growth rather than take risks. And that, to me, is a pretty significant indication.
It's going to be interesting to see here, and I guess it's based on the economic data. And my careful look here, yeah, there's stuff coming out, but now we have a real leap to get out to February 14th in the inflation report.
You really like February 14th. Is
I
it just the
mentioned it to
inflation?
myself, yeah, it's you know.
Nothing else?
Actually, what's great about it, and it moves the needle on New York City GDP, Ferro goes out. And I think after his debacle last year with a dozen roses, I think it's 2 dozen roses.
Oh, how much did he end up paying for it?
It was
something astronomical.
It was in dollars. I mean, you know, it was
significant.
You got to thank, you know, for Mayor Adams for that, for moving the needle. We'll continue forward right now. Sarah Hewen is one of the most interesting people in the economics racket. She's out of Joan Robinson's college, Girton at Cambridge, which is truly one of the toughest admits in the world. She's with Standard Chartered, head of Europe and America's research. Sarah, what was your first completely overwhelming day like at the University of Cambridge? The heritage of that program is stunning. What was it like your first day in the classroom?
It was fantastic, but I was amazed at how many men were in the lecture hall, to be honest. When I'd been at school, it had been equal women, men, and economics was still very much a male type of subject at that time. Things have changed, of course.
Things have changed a lot, and you've been a real leader on that with your coverage here of Europe and now of essentially the Western Hemisphere of Standard Chartered. What is your theme taking Standard Chartered's expertise in the Pacific of a China recovery, and how will that affect the Sarah Hewen world?
Well, I think it's pretty hopeful, really. We're looking for growth of 5.8% this year in China, and that's above consensus. But we're pretty confident that we're going to see a real surge in consumer spending. And if we look back at what happened in the US and what happened in Europe in the immediate aftermath of the first pandemic wave, helped, of course, by a lot of government spending, particularly in the US, there was a huge surge, 25% real terms increase in consumer spending from trough to peak in the first 12 months after that first pandemic wave in the US, around 15% in Europe. And I think we're going to see similarly large increases in spending that's going to drive the Chinese economy forward. In terms of what it means for our part of the world, it's great for exporters. It's been a sort of difficult year trade-wise, and we think that there's a lot of opportunities in China this year. Question is what happens to inflation. There are concerns that we could see commodity prices picking up again. Our own view is that the sort of growth we're going to see in China is not necessarily going to be driving commodity prices substantially higher. It's not going to be construction-led, it's not going to be investment-led, very much a consumer-led and probably consumer services-led boom.
Meanwhile, people are also looking at resilient labor markets, perhaps helped out by some of the demand from China, but very much domestically driven, both in Europe as well as in the U.S. How much dissonance is there between the strong labor markets that we see and this disinflationary push that a lot of people are feeling perhaps has a linear nature?
I think there's a lot of dissonance, because it's true that if we look at the US, if we look at the Euro area, if we look at UK, we have strong labour markets everywhere. And certainly here in Europe, there are real concerns about what that means for wages. We're seeing wages rising pretty rapidly in the UK. We have strike action, which is likely to further advance that. And in the Euro area, no particular signs yet of wages becoming out of control, but some concern that with the unemployment rate as low as it is, the lowest on record, that it's only a matter of time before you see wages catching up. So that does really question what happens to inflation, particularly the services part of inflation. We know that that's a concern for the Fed, and that Chair Powell has talked about the imbalances in the labour market being potentially a driver of services inflation, ex housing. So there is this dissonance between what is undoubtedly a decline in headline inflation, and certainly a decline in core inflation in the US, less so in Europe, and what we see, this real strength that we're seeing on the employment side.
What was the big takeaway for you from what we saw on Friday from the labor market report in the U.S. that a lot of people thought was something of a head scratcher just simply because of its strength?
To be fair, there was little to suggest that the labour market is weak in those data. I mean, we had some signs earlier in the week. Layoffs were rising pretty rapidly. And we know that a lot of the jobs that have been created are part-time. That said, the work week was up, the employment was strong, whichever measure. And even if you account for seasonal adjustments and the sort of population increase, it's difficult to poke a hole in that data.
Well, and this was sort of the zeitgeist over the weekend, Sarah. So let's cut to the chase and be polite. How did so many people get this wrong? Have you thought about it over the weekend? I mean, it was a shock, wasn't it?
It was, and I think that we have had some signs of the economy weakening. So clearly, second half of last year, GDP growth was strong, but if you look at the real spending data, then they were weak for October, November, December. The surveys showing activity pretty sluggish, and until we had that ISM services survey, that looked to be the case across the board. So I think it was a double whammy that we had from the payrolls report on Friday and the ISM services completely reversing out that pretty weak number that we'd had previously. So a lot of head scratching over where is the economy going.
Sarah, do you agree with Torsten Slok over at Apollo that we could get a no landing given how strong the data has been?
I question the strength of the data, to be honest. I think we need to see the next couple of months without wanting to sound too data dependent. There is a lot of there are a lot of questions over exactly what's happening to the labour market, uncertainty that this degree of strength can persist. And we know, of course, that there can be huge revisions 1 month to the next in the data. So I'd be tempted to sit back. Let's see what happens over the next month or so before deciding that there's a no landing in sight.
Sarah, thank you so much. Sarah Hewen there of Standard Chartered Bank, and talked to her colleague Steve Englander this morning as well. It's been a Standard Chartered morning, which is a good and beautiful thing. It's also a good and beautiful thing. Rarely does his entourage let us near him. Michael McKee, after Jobs Day, after 3 central banks darkens the door. I've got one question, and this came up from, I'm going to give credit to Ferroli and Silver over at JP Morgan. In all the shock of what we saw Friday, number of bodies and number of hours worked, when you combine them together, it speaks to a wonderfully productive America, doesn't it?
Well, and an America with more money to spend going forward, which is what's causing all this rethink about the outlook for the economy.
What did you learn over the weekend about the rethink? That's why we dragged you out here, thanks to your entourage.
Well, I think what people are saying is Jay Powell might be right, that we're going to see a stronger economy than perhaps people thought, which means inflation will be stickier. They have a Phillips curve model that suggests that if you're going to have a lot more people employed, you're going to have more inflation, and it'll be harder to drive wage pressures out of the economy. Now, that's not what the ECI said last week, but it is what the latest market think is this week.
Lisa, State of the Union, Senator Warren is upset. There's more people working longer hours. We should all be angst-ridden.
Well, right. There really raises a question about the union kind of membership and power at a time when there is a shortage of labor. The mystery of the people who are not participating, was that laid bare in any of the research or any of the conversations you had over the weekend in terms of why certain people just are not coming back to the workforce?
Well, we don't know the entire story, but a certain portion of it, perhaps the majority of it, is explained by the fact that the baby boomers are retiring, except for Tom and me. And they are taking advantage of the fact that many of them had to work from home and might as well have just quit. So they did. It speeded up a process that was already underway. Now, the interesting thing is we're starting to see prime age people come back to work, and we're starting to see prime age women come back to work, which suggests that maybe one of the problems we had was daycare and taking care of people who had COVID, and those problems are easing, and kids are back in school, so it's a little bit easier for people to get back to work, and we're seeing some very small rise in participation.
I remember when one person would get COVID in the class, Tom, and everyone was sent home for like a week, and now we get messages literally every day saying, 3 more kids had COVID, monitor it at home, and nobody really blinks an eye.
For all of us in surveillance, Michael, thank you for your work the last 4 days. I go home and I'm like, I'm exhausted. But it's a shadow of what he's working with, 3 central banks.
Truly.
And Jobs Day. Michael McKee there, and of course, I think he's off until February 14th, Valentine's Day, when we get the inflation
He's
so
not off.
No, he's going to Washington tomorrow.
Yeah, exactly.
To see Jay Powell.
Tomorrow, another eventful day. We have State of the Union, but before that, we have State of the Powell.
State of the Powell might be more interesting to me anyway than State of the Union in terms of what he plans to emphasize. Whether he does decide to walk back or what he decides to emphasize, but he doesn't need to walk it back right now.
Rubenstein's going to be on stage. Ladies and gentlemen, the chairman of the Federal Reserve.
Yeah, exactly.
Stay with us.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The search for survivors continues after more earthquakes hit the Middle East, leaving more than 1,500 people in Turkey and Syria dead. The first, a 7.7 magnitude quake, struck along the border of the two countries and was the most powerful to hit Turkey in nearly a century. The Kremlin says Russia's President Vladimir Putin is offering help to both Turkey and Syria. American lawmakers are demanding to know if that Chinese balloon, which was shot down off the coast of South Carolina, was carrying technology from the U.S. or its allies. Divers are trying to salvage what the government believes is spy equipment from the balloon. It's expected to be hauled up in the coming days. The head of the International Monetary Fund warns that American consumers would suffer if the U.S. defaults on its debt. Kristalina Georgieva told CBS that a default would cause a spike in borrowing costs that would squeeze average Americans. And there's a standoff between President Biden and House Republicans over raising the debt ceiling. Renault and Nissan have agreed on a landmark deal to reshape their alliance. Renault will cut its holding in Nissan from 43% to 15%. Meanwhile, Nissan will invest in Renault's electric vehicle business. The agreement's aimed at easing long-standing tensions between the two automakers. And in France, the Rothschild family plans to take its bank private in a deal valued at just under $4 billion. Shares of Rothschild & Company soared today in Paris. The bank ranked 6th globally last year in the number of mergers and acquisitions it advised on. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I think the job market's likely to remain hot, posing a real challenge for the Fed. The Fed's not likely to revert to very large rate increases, so more gradual rate increases, but probably into the 5s. But they may have to hold it for longer than market participants think. The Fed, of course, has been signaling that, but the market doesn't believe it.
Really good interview, a conversation with Glenn Hubbard of Columbia, the former dean of the Columbia Business School, and of course, former chairman of the Council on Economic Advisors on this. The word, Lisa, today is Resilient Monday. Chair Yellen, is it okay if I still call her Chair Yellen? I'm sorry. Chair Yellen's over with Stephanopoulos at ABC talking about a resilient America. We're very resilient.
Well, this more than resilient. If you take a look at the numbers that we got on Friday, not necessarily resilient, though, when you transfer it into the equity markets, which have retraced some of the losses that they had earlier in the day.
Gina Martin-Adams joins us now on resilient profits across America, chief equity strategist, Bloomberg Intelligence as well. Let's go right there, Gina. You're getting in the amount of data, 40%, 50%, whatever the earnings is. How resilient are revenues and earnings for American companies?
Not great, honestly, Tom. We're getting continued evidence that the earnings stream peaked more than a year ago. On an unadjusted basis, earnings are down roughly 8% from that peak. So even though we're going to continue arguing whether the economy's in recession or not in recession, it's very clear that the earnings cycle peaked and is experiencing a downdraft. Now, we're also going to continue to argue the degree to which that downdraft continues over 2023. Our view is we're in the worst of it now, and we will start to dig our way out later 2023, early 2024, which explains why the market itself has shown some signs of bottoming since the October lows. Right. But when we're looking at the earnings stream, it really is still all about inflation. You talk about the revenue lines. Revenue is still growing year over year, in particular, thanks to the energy sector, where we're getting a lot of revenue growth, obviously due to high oil prices, high energy prices at large. But it really is about inflation and inflation impacting margins. Companies are passing through those higher costs, but they're not passing through the entirety of higher costs, and that's resulting in margin pressure. Just on one transaction, this reported by Bloomberg, and Bloomberg reports that Danaher Medical may take out a smaller thing called Catalent. Your Jonathan Palmer pulled an all-nighter on this transaction, and I get what it is, but I've got to go back to this, Gina. You and I have talked about this before. With all that's going on, is it going to be a roll-up at a premium of well-run companies like Catalent, as well as a roll-up of the non-profitable zombie companies? Well, I think this is really interesting, and certainly the characteristic of January was a certain rush into non-profitable companies. As a matter of fact, we saw within the small cap index, unprofitable company stocks outperforming profitable company stocks by the widest margin, one of the widest margins in U.S. history for the month. So certainly the market dynamic had worked in favor of the unprofitable companies. I think this is a very unlikely sort of durable trend. I think it's a 1 month or very short-term blip reflecting a resumption of risk tolerance at the start of the year. But frankly, those unprofitable companies are going to struggle to perform well in an environment where inflation remains somewhat sticky. And I think this is part of the bigger conversation. When you've got economic growth that's somewhat resilient, inflation that's somewhat sticky, the margin pressure on those unprofitable companies in particular is extraordinary. And that was the case throughout most of 2022. I think that's going to remain a problem for 2023, though January would certainly say something very different. Well, when we look at the outlook, we see inflation remaining much higher for longer than many people are willing to acknowledge. The results of that is you want to look for profitable companies or companies with margin growth potential in a sticky inflation environment. I think it's going to be a longer term trend, but certainly January would have suggested otherwise.
Well, let's build on January. Gina, what's the takeaway as to why this divergence happened, why people favored to such a great degree non-profitable companies?
Well, look at what happened in the bond market, Lisa. The bond market keeps telling the equity market that we're going to fall into recession, that the Fed is going to ease policy. And the equity market is taking that cue and saying, okay, great. Well, the earnings stream is pretty weak, but if the Fed is going to ease policy, we're going to go into a cyclical turn on account of that policy easing. Now, well, again, is that going to be the case? The bond market, unfortunately, for the last year has really been caught off guard by Fed policy. So the equity market could get caught in a trap signaled by what the bond market thinks is the realistic outlook for economic growth and interest rate policy. But also, it's very characteristic at cycle turning points for the unprofitable companies to lead, at least in a short-term burst. You do see junk rallies characterize major bottoms in the equity market. They don't necessarily continue over the duration, but nonetheless, they do tend to characterize those major bottoms. And we would view October as a really significant bottom. Right. And certainly the capital is starting to confirm that. The market is starting to rotate into a new cycle. Now, it's not going to go in a straight line, without a doubt. But nonetheless, I think you take those cues from the bond market, you combine them with the cycle cues that we're getting from the earnings stream, and you've got a market that's trying to rotate into what is likely to be that next recovery sort of trade.
Is there a sector, Gina, that has more resilient margins, more pricing pressure, an ability to adapt to a higher inflationary environment than others?
Usually at this point in the cycle, the sectors that tend to perform better in an environment where you're moving into that new cycle, where you've got the cyclical inflection point, but you've generally got higher inflation, are likely to be the industrials companies, maybe some of the materials companies, the energy companies of the world, the financials even. You would, in past cycles where you're really focused on more of a disinflationary backdrop, you think about tech and consumer discretionary.
Yeah.
But I would argue that those segments are not going to show the resilience that they typically do because of the inflationary shift. So I think you've got to consider in your portfolio strategy the fact that we might be at a cyclical turning point, but within a secular inflation regime shift. If you're at that cycle turning point, you want to get more aggressive, certainly toward higher beta, towards cyclicals, but you've got to be really conscious of the secular inflation landscape, which is frankly really different than it has been for 20 years.
What's the summed Bloomberg Intelligence math on share buybacks and share buyback trend?
Yeah, interestingly, buybacks actually slowed precipitously throughout 2022, and companies are generally turning toward dividends. You mentioned M&A is still relatively strong in pockets, but dividend growth started to take mind share in terms of company allocations over the course of 2022, which makes a lot of sense in an environment where inflation is higher. The broader portfolio strategy is going to start to think about dividends as an opportunity. That said, those classic growth sectors like consumer discretionary and technology are still very reliant on share buyback to allow for some EPS resilience to emerge. So they continue to spend on share buyback. Healthcare, likewise, those growth-centric sectors are very buyback sensitive. And we do see some resilience there. But I think the bigger trend, honestly, is when you're thinking about capital deployment, who are the capital spenders for the long term? Who's spending money now and thinking they're going to get a return on investment, because that's a critical signal of longer term growth prospects. And who's paying out dividends? Because in an environment where inflation is higher, you've got to think about total return to stocks, and dividends are a key part of that.
Gina, what a brief. Thank you so much. Gina Martin Adams with us with all of Bloomberg Intelligence and their business, their abilities. I really can't say enough about what Paul Sweeney and company invented with Gina Martin Adams, Ira Jersey's leadership, and the rest. It's just a huge source. I steal from it every single day, without exaggeration.
It's interesting, the idea of non-profitable companies doing better by the biggest margin in decades than profitable ones in January just shows what an anomaly in some ways January was relative to the previous 12 months.
I'm blind to this. I'm like Lord Desai 101. If it's not making profit, why am I looking at it?
So to your point about the zombie roll-up that I think is kind of interesting, there have been $40 billion of M&A transactions announced over the weekend. This is, Merger Monday that wasn't, after the slowest start in decades for mergers and acquisitions, which I think is interesting.
The gold one?
Yeah, the Newmont, and the new Crest Mining.
That's like rumored but not confirmed, right?
That I believe is, yes, that's, announced. It's announced. Yep.
Wow.
And Public Storage also making the $11 billion bid for Life Storage. So there are a whole host of them. But to your point of, companies acquiring one another, maybe there's enough stability, enough optimism to get some of these transactions going again.
I think scale is everything. And when you have disinflation and your revenues are coming down, you used to do 4% organic revenue and then it ballooned to 8% organic revenue. Geez, it's coming down. Let's do something. There's that pressure there.
Well, and then you can get pricing pressure. You did it great. It's fantastic on radio. Lovely.
Radio has such an advantage. They don't have to look at me. It's a great thing. Futures negative 33, and we're deep into preparation for the State of the Union. Weston, William Cohen, 12 noon. Good morning.